we could be in this pre-recession period. Things could get much worse from here.
Our view is the economy is slowing, but it's relatively stable, and we're going to see growth into the first half of next year.
It's clear that there's more disinflation despite that growth.
What I'm really focused on right now continues to be the inflation data.
For now, inflation is still too high, even if moving in the right direction.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Hello, December, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market on the S&P 500, totally unchanged. November, massive move. Let's talk about those moves. Up 8.92% on the S&P 500. Lisa, on the Nasdaq 100, up by 10.67%. Michael Hart of Bank of America, stat of the morning.
The idea that 40-60 to 60-40 portfolio had the biggest monthly gain going back to 1991. If you're talking about sort of everything rallying together, this is great. But Michael Hartnett, of course, had a note of caution within that, saying, just letting you know, it typically is met with a drawdown.
Mohamed Al-Erim with things to say this morning in a Bloomberg opinion column. Here's the quote from him. This extraordinary November was propelled by four key factors: Goldilocks economic data, declining yields, falling oil prices, and a surge in the deployment of cash sitting on the sidelines. Extrapolating all this forward, Lisa, is subject to important qualifications that might well be underestimated during a period of understandable euphoria.
Which is the reason why people are worried. At what point does the rally in bonds become problematic for the rally in stocks? I don't know if we're there yet. We're going to get some data today. We're going to get some speaking from Fed chairs. We're going to be able to get a sense of what the economic data is going to come out next week. That said, when are we going to find out the compass? Do you just buy until there is some reason not to? Or do you get cautious proactively, even though that hasn't worked again and again? Well,
let's go to the main event of this morning. Chairman Powell coming up a little bit later. Does he speak once or twice? I think it's twice. Chairman Powell speaking twice. Any pushback whatsoever to what this market is beginning to price off the back of what we've heard from people like Governor Waller?
I think that New York Fed President John Williams yesterday really set the tone. He basically came out and he said that, yes, we're seeing some of the most restrictive policy going back about more than 2 decades, and yet we're going to have to stay restrictive for some time. He basically was trying to kind of push back, but not really push back on some of the euphoria that Chris Waller set off. I imagine that he's reflecting what we're going to hear from Fed Chair Jay Powell this morning.
Jeff Yu of BNY Mellon coming up very shortly on all of this. Dan Ives coming up a little bit later in about 2 hours' time on this program to talk about drumroll, Tesla, Cybertruck. The speed of this thing, Bramo, just going through these numbers, forget the Porsche 911 Turbo S, 2.6 seconds to get to 60 miles an hour from zero. That is super fast.
I was also looking at the add-on where you could get 450 or something like that hours before you have, or 450 miles before you have to recharge. The key issue to me with the whole thing, and not to be Debbie Downer because I'm never Debbie Downer, but
not at all.
There's going to be a real question around when this will actually be available. The cheapest model isn't going to be available until 2025. Does that matter? Especially given the fact that they're trying to compete with the F-150 and their cheapest model is coming in at a price point a little above that. I don't know. These are some of the questions. I'm more focused on price, especially after a discussion with Ford yesterday, your discussion with GM the day before. Does price matter almost most of all at this next phase of EV development?
So without a doubt, yes, but margins do too.
Yes.
And you need to compare the margins over at Tesla to the other two automakers you described earlier this week. So we've got GM agreeing to a labour contract that adds, what, $575 to each car they produce. Ford saying it's up to maybe 900. Tesla right now, and I say right now, Tesla right now doesn't have that problem. So do they have the opportunity to squeeze those guys even more on price because they've got bigger margins?
It's a great point, and it raises yet another question why they didn't come in with an even lower price for their Cybertruck. That said, it is a good point. How much is really the structure of costs going to determine the winners and the losers in the next phase of electric vehicle adoption?
Can you believe it's December?
I really can't on one hand. On the other hand, I feel like every month has been a full year, so I kind of understand. It does feel like it's been a kind of a long year.
The reason I say that, biggest bond move, we've seen yields lower since March. And of course, March was about hard landing Nirvana. November was about soft landing Nirvana. And March doesn't feel like that long ago when we were talking about bank failures going through spring.
No. Except the narrative is exactly opposite. Now we're talking about soft landing and everything is perfect and they actually accomplished it. So this is the question. Have we really changed the narrative in a more concrete sense that can last for more than a month? I don't know the answer to this. And I think that one thing that we saw yesterday that people really didn't talk about was the continuing claims really ticked up in a material way and were the highest level going back quite a number of months. To me, these are the sort of signs around the edges that people will point to and say, look, we had it coming. There were the warning signs everywhere. And they also might just be, false starts. So these are some of the things that I'm just kind of getting a little concerned about.
Are we pricing perfection? Let's get to the scores. Your equity market totally unchanged to kick off December. Futures going nowhere. Yields unchanged as well. It's almost like everyone's exhausted after November. Your 10-year, 432.23. Guess what? In the FX market, the euro going nowhere too. Lisa, 108.88.
Yeah, and George Saravello is coming out of Deutsche Bank and saying maybe the ECB will actually cut rates before the Fed. We can get into that in a minute. 10 a.m., I'm watching ISM Manufacturing. This, to me, is actually going to be really important, especially considering the fact that we've had more than a year of steady contraction in the manufacturing sector. Continuing to contract going back to or later last year. Do we continue to see that going out? Meanwhile, throughout the day, we're going to get Ward's auto sales in the U.S. to the discussion we were just having about pricing power, what we can see, how much we are seeing disinflation, as well as just movement of cars off the lots. We'll get a sense of that. And 11 a.m., Fed Chair Jay Powell speaking in Atlanta for the first time. He'll be speaking later in the day, I believe at the same event. Key question is, does he push back? Does he push back against the Goldilocks euphoria that they're going to cut rates early next year by saying that there are some stickier factors and that the data that we've been getting could be a potential head fake?
Let's get to Jeff Yu, Senior Market Strategist at BNY Mellon. Jeff, let's go straight there and good morning to you, buddy. Are you expecting any pushback whatsoever from Chairman Powell today?
I think the market is expecting pushback. I mean, the number of times over the last 48 hours, clients or colleagues have been asking, hey, do you think Governor Waller actually meant what he said? I think that tells me there's not really that much confidence that Governor Waller actually meant what he said originally, right? So that means the market, yes, they are trading risk on, they are trading risk, the easing in financial conditions, but I don't think there's a whole lot of conviction out there. So I think the bias is towards better take some of those risk on trades off right now.
If that's the case, Jeff, what did Governor Waller say that if he could go back, he would edit?
I think he would stress contingent upon data continuing to evolve in the way that they stress. So go back to data dependency. If it ain't broke, don't fix it. I think that point should have been elevated rather than maybe forewarning that potentially data or whatever they're seeing within the Fed data is starting to come off and maybe hinting, oh, I know something that you don't know in terms of the markets. I think it was maybe that confusion in terms of the forward outlook and, given his overall credentials, on the spectrum, all of that as a package, maybe he could have rolled back. But I think today for Chairman Powell, it's his chance to really set the record straight. Can
he really set the record straight, though, Jeff? And I say this because right now the market is saying, okay, you're data dependent, so are we. The data that we see, to the point we were speaking about with Neil Duddy yesterday, is a lot of disinflation in the pipeline. Is that basically going to be the message that the market is sending, regardless of what Fed Chair Jay Powell says?
So the second most comment that I've heard over the last 48 hours is markets are hearing what they want to hear. So I think we're going to get that sort of a reaction function today as well. If the market is now less biased towards easing financial conditions and risk on, and they're going to be if markets are going to prefer more wondering whether they want to go back towards some degree of caution and Fed higher for longer, then they are going to perhaps hear those comments from Powell a bit more, and then that will be reflected in asset allocation accordingly.
From a position standpoint, do you think that we've gone as far as we can go at this point and that we are set for some sort of retracement, that people are going to have buyer's remorse just a touch in December?
Well, if I look at the dollar, yes, because the dollar heading into last week, if we look at our custodial flow data called iFlow, dollar selling, which is a good barometer for risk appetite, risk on, that reached the strongest levels on a monthly basis this year, right? So that to me is a sign that it's time to mean revert. I'm not pushing back against the dollar valuations view per se, but when you get to that extreme, I think it really is time to really dial things back. If you've had a good rally, if you've managed to get back into the back in terms of P&L, maybe heading into year end, it's time to square things up a bit.
Take the rest of the year off, I think is the message there. Lisa shared that stat from Bank of America this morning, Jeff, from Michael Hartnett, the 60-40 portfolio up 9.6% in November, best month since December 1991. Jeff, when you say dial things back, what does that mean after everything's rallied? Where do you go?
So you get back to square, and if I look at the FX market, and if I look at broader asset allocation, you go away from euro. Where can you actually recover a bit of, let's just say, risk off or dollar on, that kind of a sentiment? I would focus on what's going on with the Eurozone right now. As you mentioned earlier, one of my counterparts noting ECB will cut before the Fed. I absolutely agree with that. In the following order, ECB, then a quarter later, the Fed, and then maybe up to a quarter later, the BOE. I think that's how it's going to go. And the consumer and the services inflation aside, the key difference between the three of them, fiscal. One is cutting, one's pretty much flat, one is expanding. That's going to make the difference over policy expectations in the next 6 months or so.
Jeff, let's go further. The sequencing there. The ECB goes first. How early? And what's going to prompt it?
Right. So right now I'm looking at Q2, but I wouldn't even rule out, March. Let's look at the forecasts for December. When they announce them. If there's a clear path towards inflation, core inflation even heading towards 2.5% or lower, then you need to start at changing your bias and looking at easing already. And people mentioned, what is euro-dollar doing up here? When you look at the data in Europe and you look at the fiscal situation in Europe, and by the way, if you look at euro-dollar strengthening, that actually accelerates disinflation in Eurozone as well, because it's a trade-oriented currency. Import prices start to come off. So the more the higher the euro is right now, the more likely that the ECB will move earlier. A combination of things, but I'm looking at those forecasts heading into December, heading into the December forecast round.
Before we move on, how much downside then do you see in the euro-dollar pair?
I see parity next year. At least we can touch that and then move on from there. Yep.
Wow. Okay. So parity next year, which is definitely something that is quite a bold call. And I'd love to follow up with you in a little bit on that.
Absolutely.
But there's a question of how much there is going to be a cutting wave next year. How far is the ECB going to cut? How far is the Fed going to cut?
So from the ECB's point of view, I think at the minimum, when they start cutting, then they'll start maybe around quarterly increments. A lot will have to do with what will happen with PEPP as well. Just in general, in terms of can QT start? Can a QT stop in that context as well? But also, from the Fed's sense, what the Fed needs to look at is where does data take them from there, and also their balance sheets unwinding at a stronger pace as well. But if the Fed starts in H2, I think overall it's going to be a one cut per quarter kind of a pace to start off with. If data is more to the downside, then they can accelerate.
Jeff, pause. Headline: the euro back to parity. Jeff, you told us what your client conversation sounded like. I imagine you've shared that call with them. What did they say back?
Yes, absolutely. Not too much pushback, to be honest. And I think if I had that call maybe, say, 6 weeks ago before the Constitutional Court ruling on the budget, I would have expected a bit more pushback in terms of valuations and when the dollar is. But now, considering the dollar has fallen quite a bit and people are probably dialing back their dollar views, plus the fiscal situation in Germany and also the data is just not picking up, I'm actually not seeing too much pushback. I was on the continent yesterday, so in Switzerland, I'm sure they're not using the euro at that point, but I don't get the sense that there's too much disinterest in that view. But of course, when it comes to the franc, they're worried about a weak euro as well, because then the SNB may have to start to reverse. Right?
Hey, Jeff, love it. Fantastic. It's always good to catch up, sir. Jeff, of BNY Mellon, kicking off our December coverage with a massive call in the FX market, looking for the return of parity on the euro against the dollar. Lisa, right now, negative on the session, just a touch, 108.86.
Three things. Number one, Christmas presents in Casa Ferro will be very good if it gets down to parity. Number two, travel. Wow. Talk about reigniting that, because that's really fallen off a cliff in the recent months. And then three, what does this mean in terms of how far these economies can continue to diverge, right? Does this count on Goldilocks in the U.S. versus a deteriorating stagflation-like environment in Europe that's causing some sort of retracement by the ECB? These are really key questions to me, because right now we do not understand inflation. We don't understand why it rose as much as it did. We don't understand why it's coming down as quickly as it is. And people will come up with reasons and narratives to explain it. I have not heard one consistently that gives me confidence that we really have a sense of how quickly things are going to come down.
Do the people who control the Twitter account at the White House understand inflation?
I think not, and we can get into that. But basically, there's a community note on Joe Biden's comments, so that just gives you a sense.
I'm guessing the president didn't write that.
We can talk about this. We need a little more time.
I'll make some time in a moment to talk about it. Equities just about unchanged through most of this morning on the S&P 500. We're going absolutely nowhere after a massive everything rally in November. Hello, December from New York City this morning. Good morning. Live from New York City this morning. Good morning to you all at home. The price action. What a month of price action for November. December, things settled down. We're totally unchanged across the board here on the S&P, in a bond market and foreign exchange as well. Yields go nowhere. This morning at least 4.33 on a US 10-year. But wow, did they go somewhere last month. Your 10-year yield in the month of November, Lisa, lower by more than 60 basis points. Your 2-year yield ended the month lower by more than 40. This whole curve shifting aggressively lower.
I'm glad you put it that way. You're talking about the whole curve, because there's some aspects of the rally that make a lot of sense, like people pulling back their expectation for short-end yields, the idea that the Fed might not hike or won't hike again, and that they might cut rates next year. The long end I'm less certain about. I don't understand whether we've actually understood that inflation, yes, is going to come down aggressively over the next 10 years. And, oh, yeah, that the auctions don't matter. And I know that Tom would be rolling his eyes and saying, here she goes again, talking about the auctions. But the U.S. is selling more debt, and someone's got to buy it. And the question is, at what price?
TK back with us on Monday, by the way. Let's talk about inflation and inflation pushback. The president out with a tweet yesterday. I have no idea who actually wrote this tweet, but it's got the president's name on it, so we should probably read it. This is what he says. Let me be clear to any corporation that hasn't brought their prices back down, even as inflation has come down. It's time to stop the price gouging. Give American consumers a break. Chorus on Wall Street, led by Jim Bianco. Apparently, he does not know the difference between prices rising at a slower pace and prices falling. It signals he does not listen to Secretary Yellen because she knows the difference.
It's not great when the president needs community notes underneath his tweet to explain why he's not exactly getting it right. So then, does he understand, or do his people understand the difference between slowing inflation and deflation? Or is there a sense that he's trying to cater to a certain political anger that has created a real negative draw on his polling? I mean, it feels very political, and yet I wonder if anyone said, just letting you know, it's going to seem a little off considering it's economically wrong. Without doubt, it's the latter and not the former. I refuse to sit here and believe that someone like Lael Brainerd of the National Economic Council, Janet Yellen, Treasury Secretary, don't understand the difference. Of course they know the difference. This is pure politics and nothing else. And it's coming at a time where he was talking about price gouging with gas prices, and gas prices are now the lowest going back to January. And this raises this question of, okay, well then what is the coherent policy going forward if the Inflation Reduction Act was more geared toward certain infrastructure building? What is their plan to message this? Not necessarily to address inflation, but to message this heading into next year. Did you get a coherent policy view last night in that debate? I got one very clear message. Which was? And Gavin Newsom said that pretty directly, which is that neither he nor Ron DeSantis would end up being the 2024 nominee for president. His view. Let's get another one. John Lieber joins us now, Managing Director at Eurasia Group and former policy advisor to Senator Mitch McConnell. John, great to catch up with you, buddy. It always is. Let's start there with that debate yesterday evening. The governor of Florida against the governor of California, Sean Hannity of Fox News in between. Surely Sean was the only winner, John, last night.
Yeah, it was more like a wrestling match than a debate. I mean, it was painful to watch, just the two governors shouting over each other, trying to insult each other. Most of these debates these days are framed around a politician trying to get their talking points in and get their one-liners out. Both guys achieved that for sure, but I don't think either of them really helped their case that they should be the next president of the United States. And of course, as mentioned, Newsom's not going to be the nominee because Biden's blocking his lane. So this is probably more of a preview for 2028 if DeSantis can still find a way to be relevant in another 4 years. But that debate was painful. I don't think it did anyone any favors. Find a way to be relevant. Are you basically saying that the nail is in the coffin for Ron DeSantis' bid to be the Republican candidate for president? Yeah, I think it's really unlikely that anybody not named Donald Trump is going to be accepting the nomination in July. And his polling lead is just so massive, and he is so dominant inside the party in most of the key states that really matter for the primary. Nikki Haley's having a little bit of a boomlet right now, trying to consolidate the support of kind of the donor class of Republicans who are really key to making sure that she can make a deep run into the primary season. But the donors aren't the ones that vote. It's the voters that vote. And right now, the voters are telling pollsters, at least, that they strongly favor President Trump in this. And DeSantis' window might close. I mean, this is kind of, we've seen this before. Chris Christie was kind of the hot thing in 2012. And by the time 2016 came along, the world had moved on. And that could happen here to Ron DeSantis if he doesn't find a way to be competitive in this nomination process.
Let's talk about President Biden. You said that he was blocking Gavin Newsom's lane. Let's talk about his presidential re-election bid and this tweet that we just read, how he's messaging the inflation story. What do you make of the fact that he basically put out something that was just economically incorrect in terms of disinflation versus deflation?
Yeah, I don't know who's running the White House's social media account, but they obviously aren't big surveillance watchers, because this is a complete nonsense. And, I think they're looking for somebody to blame. They know inflation's going to be a drag on President Biden in his reelection. And by creating bad guys out of American corporations who they claim aren't dropping prices, they can point the finger at somebody other than themselves. And that's all this is. It's a simple political narrative. It's not going to work. Consumers are still deeply upset about inflation. Inflation, unlike economic growth, is really something that consumers see every day in the prices of the stuff that they're buying. They know price levels, even if the growth rate is down, price levels are much higher than they were 2 years ago. And they see it in all the consumer goods when they go out to eat at restaurants, and people are mad about it. And it explains this disconnect that I often get asked about why, the unemployment rate is low, jobs are being created, but people are unhappy. And the reason is prices are higher, and the American people know it.
They're frustrated, Bramo. We've talked about this a million times. John absolutely nails it. People at home feel like politicians are gaslighting them every time they talk about prices in America. The cumulative inflation over the last 3 years is real, and people notice, as they should. Prices are higher. Especially because it's things like rent that is something like more than 20% higher. It's things like groceries. So then how do you challenge someone's feelings with economic data that is confusing? I mean, it isn't on an economic perspective when you just take a look at it and what disinflation actually is manually, but the trajectory of it and what it means and what it will actually filter into how people feel, that's a lot more complicated. So, John, this story was even more true in the midterms last year. It didn't kill them. It didn't kill the Democrats. John, why will it next year?
I think Biden carries the blame for inflation in a way that the congressional Democrats do not. And of course, the big issue in the one thing that really matters when looking at trying to understand who's going to win a campaign is what are the top issues that people care about. And last year, for sure, inflation was an issue. But the overarching issue that drove Democrats to the polls last year was over access to abortion. And this is something that's been a tailwind for Democrats in every election since the overturning of Roe versus Wade. It will probably help Biden next year as well. And it's one of the reasons that I think he can overcome some of the major deficiencies that he faces in his reelection campaign, including the bad vibes around the people's feelings about the economy. So I think that people vote for complex reasons. Inflation's one of them. Abortion's another one. Republicans are going to show up to vote on immigration and crime and a totally different set of issues. But inflation's only one part of the mix here that's going to be weighing on Biden's reelection.
Hey, John, you're one of the best. It's great to catch up. John Lever there, if you raise your group, on the inflation story in America and what it means for the politics of next year. Great TV last night. Just great TV. I just get the feeling, Gavin Newsom and Sean Hannity honestly should have a show together. I've seen several exchanges with them and it's just absolutely brilliant. Honestly. They both enjoy the game of it. We want to see more of this stuff, I think, more debates. You might not be happy with the character, the tone of the debate, but honestly, I'd much prefer to see people on stage talking about big issues than hiding away on Twitter, pounding away and saying nothing. I would agree with that. And at the same time, this is the problem, is that the former president, Donald Trump, has not attended one Republican debate. Hasn't needed to. And he hasn't needed to. So at what point do debates become liabilities for people more than anything else if the candidate's already almost a lock? True. AMH is coming up to talk about this. We'll catch up with Anne-Marie in the next hour. Coming up shortly, Sarah Hewen of Standard Chartered from New York City this morning. Good morning to you all. Welcome to the month of December. Just 1 month left in 2023. From New York City, this is Bloomberg. Good morning, December. What a November. Here are the final scores for the month of November in financial markets worldwide. Equity markets, let's start with the S&P. Stocks up 8.92% November. Best since July, since last year. Amazing. Heading for a fifth weekly gain fifth weekly gain, equaling the longest weekly winning streak going back to June. On the NASDAQ 100, so we've got to talk about the month for the NASDAQ, but let's talk about the last week as well. So the NASDAQ 100 on the month up by close to 11%. Best month since July of last year, just like the S&P, but down slightly on the week for the first time since October. You'd have to say, I know we've had a massive move, Lisa, but things just starting to stall out more recently for the NASDAQ's run. Which
really is the reason why Michael Hartnett over at Bank of America was saying that usually after incredible rallies like this, you do get a pullback. The question is from where? I like to take a look at flows to understand just where some of the sentiment is. The amazing thing is we've been talking about what will it take to get cash off the sidelines. Well, people are just pouring money continually into cash. And over the past week, we saw $75 billion of additional money flow into cash. So in order of finding out when people are done with that trade, not so fast. This is the question, right? How much conviction do people have versus just jumping on a train and being, who was it who said, I'm a FOMO guy?
Yeah. That was Brian.
Brian, yes. Yeah. Brian from Oppenheimer.
Brian Levitt. And he was right. I'm a FOMO guy. And, he was right not to miss out. I think what's peculiar about the month that's just gone by, it wasn't just stocks. It was bonds as well. And you mentioned Michael Hartnett, Bank of America. We've just seen the best return for a 60-40 mix going back to December 1991. We're talking about a close to 10% gain because yields were aggressively lower across the curve. 2-year down 40 basis points, 10-year down 60. Just monster moves, Lisa, in fixed income.
And the last time that we saw this kind of move was December 1991 when the USSR was dissolved. And there was a lot of questions internationally. That's great framing. About, what was going to happen. It wasn't that people just were suddenly coming to the realization that everything was fantastic and we would achieve the soft landing that the Fed sought out to achieve.
Are we pricing perfection? Right? Just the ultimate soft landing, which means fixed income can rally, growth is slower, rates get cut, but equities do okay because we don't go into recession?
How do we even understand what's being priced in? And I know that I've just been asking a lot of questions this morning, but one thing that I've been wondering about is when you talk about big tech, what do you understand in evaluation when people say that artificial intelligence is a moonshot and it's going to yield these incredible productivity gains and you're going to see profits surge because they're going to be the only game in town? How do you then understand evaluation, right? How do you then understand whether people have gotten over their skis when it is a technological advancement that people are betting on and the monetization of that? And then you bleed it into the rest of the market, which is still lackluster. And you're seeing money go out of small cap companies. So I don't really think that there is an easy way to dissect what price to perfection means at this moment.
We've done equities, we've done bonds. Let's push the bond move through the FX market. I think you know what's been going on over the last month. Dollar, weaker, euro, stronger. Just short of 109 this morning. We've pulled back more recently, but still, that was the best month for the euro of the year so far. Now, we've had the call of the morning so far from Jeff Yu of BNY Mellon. Jeff Yu saying parity on the horizon, ECB cuts first. ECB cuts first.
And George Saravellos over at Deutsche Bank agrees with him, also saying the ECB will cut first. Euro parity is a pretty bold call, considering that a lot of people are saying that we're seeing the beginning of a protracted dollar decline. Does euro parity with the dollar mean that there is global weakness that continues to put the rest of the world on the back foot and the U.S. very much still in the center?
Got to make a China call as well. Making a China call has been so tough over the last 12 months. We'll get to that in just a moment. Under surveillance this morning, Israel resuming fighting against Hamas after a week-long truce between the sides ended. Israel saying its jets were already striking Hamas targets in Gaza. Shortly after the ceasefire expired, the truce brought the release of captives on both sides, as well as allowing for more aid to flow into Gaza. It's thought Hamas is still holding around 130 hostages after taking 240 when the war broke out. Lisa, we were talking about how fragile that truce was. That truce ends.
It's not a complete surprise. It's deeply unfortunate in many ways, but it's not a surprise given that it was getting increasingly tense with every hostage negotiation. There are a lot of questions about how this evolves going forward. Qatar has said that it's still talking actively about negotiating some additional truce, but we've been saying this again and again, and we have to keep repeating it. The goals have not changed. Israel still says that it needs to eradicate Hamas in order to have a country. And Hamas, the Hamas leader, came out over the past couple of days and said that this was just a beginner, a teaser to what was to come, and that there will be many worse things than October 7th. So these are some of the talks on both sides that highlight how neither side has given up their underlying objective.
There's some shocking rhetoric there, isn't it?
Shocking.
So in about 45 minutes' time, we'll get the Anne-Marie view on things. AMH joining us from Washington. Also need to talk about this. 2 years behind schedule. Congratulations to the team at Tesla launching its new Cybertruck, but saying its cheapest model won't be available until 2025. Production delays have held back the car, with CEO Elon Musk calling it, quote, insanely difficult to produce. The most expensive version of the truck, the Cyber Beast, priced at almost $100,000. Lisa, that will begin delivery next year.
Do you think it's attractive?
So I said initially when this first came out, it looked like a child had drawn it, right? I thought that this is, build a truck, draw a truck that you think, totally.
Yeah.
How wrong was I? Because the order book just went through the roof.
So one of the reasons why it's insanely difficult to make is because it's stainless steel on the outside, which evidently is very difficult to create into components that are easily placed together. I'm not an auto manufacturing expert, as you probably could just tell, but to me, this really raises this question, will this be the new look? I mean, is this basically going to be, Back to the Future, the models? What was it called? The DeLorean with the doors that went open?
You know your cars. Come on, give me a break.
Yeah, I know the DeLorean. I know a fictional car that came out of the 1980s movie. But there is a real question here about exactly the tone that it sets, whether it competes with the F-150, whether this is for commercial use or whether people just want big vehicles that look like their kids drew them.
Do they want EVs or do they just want Teslas? Can we talk about that a little bit more? Do people just want Teslas in this country or do they actually want EVs? When you speak to Ford, to GM, and you talk about their numbers, I don't hear the same thing from Elon Musk.
What John Lawler said yesterday I thought was really interesting, which is basically initially there was the ability to price things more highly and you could have more of a luxury price point because the people who sought out electric vehicles were looking to be the early adopters, right? Now it's a different kind of equation. I'll say, as somebody who is shopping for a car, you're looking for cost, you're looking for ease of refueling, of being able to keep going. And sure, you're also thinking about the environmental factors, but you put all those things together and you get a very different car that people gravitate toward than some of the Teslas at the price points and the margins that they've been selling them at.
It is funny that this is the week we're talking about the lack of advertising on X. And at the same time, here's a company that is getting free marketing the world over this week, and the focus is on this brand. There's a great video out on Twitter of this truck towing a Porsche, beating a Porsche in a drag race.
Yeah.
What does Porsche do in response to that?
I don't know. I really don't. It's a good question. And this is something that all of the legacy car makers are having to deal with, including the luxury ones. And luxury hasn't been immune to this. And we've been hearing that from BMW and the like. So, this is, okay, over to you, Porsche.
Free advertising. Tesla just, marketing genius. Absolutely. Let's finish on this. Shares of LVMH falling this morning after Morgan Stanley downgraded the luxury retailer to equal weight from overweight, expecting the company to face a, quote, difficult start to next year, given its dependence on spending out of China. All of this as China's biggest celebrities flock to Louis Vuitton's first ever fashion show in Hong Kong as they look to boost business in the region. The call on China has been tremendously difficult over the last 12 months. Let's have that conversation right now with Sarah Hewen, Head of Europe and America's Research at Standard Chartered. Sarah, before we get into thresholds for rate cuts, can we just build on that just a touch? Europe and the dependence on China, what kind of moves can we expect in the Chinese economy in the next 12 months? And what do the last 12 months mean for the European economy going forward?
In terms of China, clearly the situation has been very challenging, but actually growth has performed better than expected. We've always had an above consensus outlook on the Chinese economy, and we've seen consensus moving up towards us, and indeed IMF forecasts also moving up towards our own forecasts. Clearly, the real estate market is going to be struggling for some time, but what we're seeing is consumer spending recovering gradually. Consumers are drawing on savings, even though income growth is relatively weak and consumer confidence is not great. But we are seeing a pickup in consumer spending. And of course, China has some huge strengths in particular industries, and we're seeing real strong growth in EV and other technology related production and exports. So growth likely slower next year than this year, but not dramatically so. We would expect that the official growth target will probably be continued at 5% for next year. In terms of Europe, real challenges for the domestic economy. We've seen already negative growth across much of the individual countries in the region, and it seems as if policy tightening is really taking effect. Interestingly, though, unemployment stays relatively low so far, and that probably is going to be the final leg to fall for the European economies.
Sarah, what do you think of the call that we heard from Jeff Yu at BNY Mellon earlier this morning, that next year we could see parity for the euro versus the dollar?
Well, we would agree that the ECB looks likely to ease rates before the Fed, and the data on the economy certainly would suggest that the US economy is in much better shape than the European economies. Inflation is coming down very rapidly in the euro area. It's coming down in the US. We have some questions about how getting from 3% to 2%, that final leg for US inflation, how well that can be achieved, or how quickly that can be achieved while you still have a pretty solid labour market. So we would expect ECB easing ahead of the Fed to point to a weaker euro. Once we get clear signs that the US unemployment rate is rising, that's the point at which we think the dollar starts to come under more pressure. But certainly our forecast for euro over the coming weeks and months would be weaker than it is currently.
So is next year just deja vu all over again? Are we basically getting the U.S. being, the cleanest shirt in the laundry bin, or whatever cliche people are going to put out there, and we're going to get them basically getting Goldilocks, soft landing, and the rest of the world in a world of hurt?
I mean, we're thinking that the US is going to, the economy is going to stall later next year. The impact of policy tightening is clearly coming through, and that impact is going to intensify over the next few quarters. So although employment, the jobs market is relatively solid at the moment, then it's likely that we'll start to see hiring fading, unemployment rising. Consumers, of course, that have been such an important part of this recovery over the last couple of years, consumers are starting to run short on savings, certainly for the lower income quartiles, and the impact of higher unemployment, I think, will undermine sentiment such that the consumer starts to fade away. So certainly for the US economy next year, we think that growth is going to stall in the second half. It's not a particularly great outlook, really, for any of the major economies, and that's sort of what you would expect given the extent of policy tightening that we've seen over the past year, 18 months or so.
And the fact that we just had 5% plus GDP growth in the third quarter in the United States. Sarah, thank you for the update. Sarah Hewen there of Standard Chartered. I really appreciate what Standard Chartered have done over the last couple of weeks. A lot of people out there put Canada-based guidance out there for the Federal Reserve. The cuts are going to come, and then you choose a date on the calendar. They put out some threshold-based guidance and basically indicated that they think this is where the Fed's going to cut. If unemployment gets to 4.5, core PCE comes down to 3, that should allow the Federal Reserve to pull back. That's far more useful to me than taking a guess on a calendar and saying June, back end, second half, first half, early March, whatever.
But this is part of the reason why Chris Waller actually made such an impact on the market, because he did sort of set loose parameters. Maybe they were more extreme, but talking about how if inflation's come back down to target, it makes no sense at all to keep rates where they are. So at this point, people take a look at what's in the pipeline in terms of disinflation, at least over the next couple of weeks, in the next couple of months, and they say we're going to meet those thresholds.
That if is not a big if.
Yes.
If you're listening to Neil Dutt of Renaissance Macro.
Exactly. Well, that's what I was talking about.
Fantastic exchange on this program in the last 24 hours. You can find that on Bloomberg.com. From New York City this morning, good morning. Your equity market just about unchanged on the S&P. This is Bloomberg.
The lesson of 2022 and early 2023 was that we cannot control what happens in the rest of the world, especially as it pertains to the supply of oil, the supply of natural gas. So from my perspective, if we get another shock in that market. And by the way, it doesn't have to be because of a war, although in the past 2 years that has been the case. It could be simply that OPEC Plus decides to curtail supply, and we get a Brent going back up to the low 90s as a result of that. Again, it's a question of how much they curtail supply by, but that's the biggest risk right now.
That was Wednesday, and then yesterday, that's exactly what OPEC Plus did. Crude this morning, 76 on WTI, Brent crude, $81.11. We'll get into OPEC Plus in just a moment. If you are just joining us, big day today. Chairman Powell closing out Fed speak, going into the quiet period ahead of the December Federal Reserve meeting with the last word on a big week for a lot of Fed speakers. We've talked about the selective hearing in bond markets. We seem to be listening to the likes of Waller, Bostic, ignoring the rest. So let's listen to the likes of Bostic and Waller. Bostic says this: our research and input from business leaders tell me the downward trajectory of inflation will likely continue. Governor Waller said this: something appears to be giving, and it's the pace of the economy. That line to me, Mike McKee and I went back and forth on that just a little bit yesterday. What's giving in the US economy right now?
There is a sense that people are looking for discounts. There is a sense that consumers are starting to push back a little bit on the margins to high prices. There is a sense that certain consumers in particular are having a difficult time. And I think about Walmart's CEO talking about outright deflation in goods. And I'm thinking about saying that over the last 90 days, they'd seen a market deterioration in demand. So maybe that's some of it. I think the other thing is, if you take a look at small businesses, they're not doing well. And if you take a look at their stocks, but if you also take a look at their capital objectives and how they're going to achieve them, this is a tough moment for those, and they employ a lot of people in this country. Anecdotal
data that they get, you see it in the Beige Book, they hear about it all the time. It's been telling them this for a while. In fact, I would go back to August. We heard this in Jackson Hole. I think it was Patrick Harker who said exactly the same thing about things getting a little bit more difficult. Stop hiking.
Well, and he said that anecdotes have been a better guide than some of the more traditional data. Mary Daly also spoke yesterday, and she's been really thoughtful about this, and she really focuses on some of the anecdotal data, which she puts together and doesn't call anecdotes, but she calls it sort of qualitative data.
It sounds fancier.
Yes, exactly. It sounds like it's a sort of more scientific approach, which that's how she views it. There is a question here. When she looks out, she says she's not even thinking about rate cuts. And she said that. She pushed back more aggressively than some of the others. So it raises this question. Are people seeing different anecdotes depending on the region?
True.
Is this reliable? I mean, I'm telling you, this is such a confusing moment. And Fed officials are just as confused as
Yeah, but what did Daly tell you back at the Economic Club in New York? When things start to conflict, when you start to get more and more contradictory evidence, it means you're at a turning point.
Always. And then we just don't know what the turning point is too. And this is sort of normal, but it's been a while. And so if the question is, we don't really know where we're heading, how can Fed officials give true guidance?
Do you think this is what OPEC Plus is trying to get ahead of, going into next year and beyond?
You know, I spent a lot of time thinking about OPEC Plus because I found that also confusing. As you can see, I feel very confused after
about
this past month about
a
lot of issues. But they basically came out and said voluntary cuts, maybe trying to placate Angola and Nigeria. To me, how much is OPEC Plus basically a leveraged vehicle of China? How much do they basically give a sense of Chinese demand more than they do America? And how much are they leaning into this idea that economy is slowing much more significantly?
Markets in Asia becoming increasingly important over the years for that group of oil exporters. Nadia Martin-Wiggin joins us now, the director at Svelland Capital. Nadia, let's start there. This word voluntary, how important is that word voluntary at OPEC Plus?
I think the market finds the word voluntary very problematic because it means that the group did not manage to together agree that this is what we actually have to do. And this is why the oil price has not strengthened since it was announced.
What kind of follow through do you expect off the back of the announcement then? We know what the market's preoccupied with, a single word. What are you telling clients?
Well, that on the margin, we then see that there's around 300,000 barrels per day coming less from UAE, coming less from Kuwait, and 100,000 barrels per day coming less from Saudi Arabia. So that makes Q1 look slightly better and call it a balanced market, right? But it's only a Q1 cut and it doesn't really change the picture. And again, you know, what it was different about this OPEC Plus meeting is that it's not a long duration cut, right? Last year, they made it a long duration. And now they're only looking at 3 months forward. The expectation for them is, of course, that we will start to see demand pick up and then we will see draws, especially into the second half of next year. But what we saw throughout this quarter is a lack of draws does not make the oil price rally. right? And we're going to see the same in the first quarter, we believe.
There was a story, Nadia, on the Bloomberg talking about how algorithmic traders are confusing all of this and that we can't really get the same kind of signal from oil prices because of this. Do you buy that, or do you think that oil prices are sending a very strong signal about growth globally, but also particularly in China?
Well, I think oil prices are okay. It's not a low oil price. It's not a high oil price. It's a healthy oil price. I think what we have to get our heads around is the fact that China has changed as an economy, right? And so we're not going to see the levels of GDP growth that we were used to, but probably where we are this year, things will continue to go on year over year. Of course, this year we saw 1.5 million barrels per day year-on-year growth in oil demand. And in our view, we'll see 600,000 barrels per day next year, which is probably slightly higher than consensus. But it's not only China. It's also India. It's also non-OECD Asia, ex-China and India, that are really driving things. In contrast to the U.S., that even though the U.S. economy, we're firm believers in a soft landing, the problem is the rise in fuel efficiency every year in the U.S. And this is why the driving season disappointed this year, and it's probably going to disappoint next year. Add into that Tesla and EV purchases, that is also a headwind on that demand growth.
If that's really a big driver of why prices, as you call them, healthy, but not as elevated as people would expect, how much can we see prices continue to decline as EV adoption and some of the other types of non-fossil fuel economies build up?
I think the main difference there, on the demand side, yes, we will see slow demand. And, already for next year, demand growth in our view is 1.4 million barrels per day year on year for the whole world global demand growth, right? But some estimates are already calling for less than 1 million barrels per day, right? I think the other aspect, though, is the supply side, right? Is that right now we are in this still shale boom, and that will continue for probably another, max 2 million barrels per day. And, we'll say peak U.S. production will be at 15.5 million barrels per day. So when we think about the balance in prices, we will then still have strong oil prices because these long cycle investments are not happening at the pace that they have in the past, given this relatively healthy oil price. So I don't see a long-term negative price path for oil, and I expect actually it to strengthen over the coming years. We just have to get through this U.S. shale boom growth period.
Nadia, appreciate your view. Nadia Martin-Wiggin there of Svelland Capital. Imagine if a central bank came out, news conference, we're hiking rates, but it's voluntary. How would the market respond to that? Exactly how crude responded to it.
That's what I was going to say, just completely confused, and that's basically the response in crude.
Pfizer, I want to talk about that name in the pre-market right now. Bit of news for you. Stock is dropping, and it's dropping development of its experimental weight loss pill after more than half of patients in a mid-stage study, Lisa, had to stop taking it due to side effects like nausea and vomiting. We're down 4% here in the pre-market.
We've all been kind of waiting for this, right? To some degree, because we hear anecdotally about some of the side effects of Ozempic and some of the others. And there's this question, at what point is it problematic? And it seems like Pfizer has reached that threshold. So this raises a couple of questions. Number one, is there going to be similar types of follow-on to some of the more established drugs as people take them for longer? And then number two, how high is the barrier to entry as everybody in the entire industry tries to get in on trying to, get weight loss to happen?
Look, they had a massive boom off the back of a pandemic. It's faded. It's gone. Now they need to get back to work and catch up with Novo Nordisk and Eli Lilly.
Are you saying that basically Ozempic is a new COVID vaccine?
No, I'm saying that the COVID vaccine was mandated in such a way that it benefited that company in a disproportionate manner than it did other pharmaceutical companies in that era.
Absolutely, that's true.
And I'm looking at these moves this morning, and as this stock drops, if you just pull up the charts of Lilly, Novo Nordisk, just see the chart briefly, just starting to inflect the other way. Just off the lows of the session on both of those names elsewhere.
Yeah, and they've got more established footprints, and maybe they also have less high to fall from, to your point, because Pfizer really did benefit so significantly. I just wonder, are people really going to take this for the rest of their lives, and how much of an advance?
I don't know. I just find it fascinating.
It is fascinating.
You talk about this morning, you've got more questions than answers. This subject right here, I have so many questions about.
I agree with that.
It's absolutely fascinating. What it could change. And all the rest. What could Chairman Powell change about this market rally through the month of November? Chairman Powell coming up a little bit later. We hear from him not once, but twice.
We could be in this pre-recession period. Things could get much worse from here.
Our view is the economy is slowing, but it's relatively stable, and we're going to see growth into the first half of next year.
It's clear that there's more disinflation despite that growth.
What I'm really focused on right now continues to be the inflation data.
For now, inflation is still too high, even if moving in the right direction.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
There's a real sense of exhaustion in this market after the month of November. Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market this December. Good morning, December. Equities totally unchanged on the S&P 500. Through November, equities rip, bonds rip, yields plunge. Chairman Powell, is he going to disrupt the party a little bit later?
Well, a lot of people are saying probably not, but that's the big question. I will just say that as I was telling everybody all of the questions that I have about absolutely everything, and I keep telling you about how I don't understand anything, someone sent in Led Zeppelin's Dazed and Confused to me so that I could really kind of, just vibe with that this morning. That's sort of where we all feel, I think. There's a bit of whipsaw after so much ping pong.
Bond market has supported this massive move in equities. If you're looking at the 60-40 portfolio, you shared that stat earlier. I think it's worth repeating. To see 60-40 deliver the best month since when? 1991.
December 1991 when the USSR was when it was dissolved.
What happened to the end of the 60-40 portfolio?
Well, is this the beginning of the reprisal of it? And this is really the ultimate question. Can bonds and stocks continue to rally together for a longer period of time? I don't know the answer because we don't actually understand where inflation is going to settle out at. Some people are saying it could for a bit longer. Some people saying that it's gone too far too fast, but it doesn't mean that the moves are actually wrong. Other people are saying that either we're going to get reinflation to some degree come next year, and then you get suddenly this real concern and a whipsaw action where bonds lose value, or the opposite, we go back to 2% in a heartbeat, and everything is Goldilocks, and people lean into the moves that we've already seen.
That's the bet, right? The soft landing, a perfect soft landing, which is the bet that JP Morgan and Marko Kolanovic and the team are pushing back against. They think it's too perfect, too pretty, too good, and ultimately it will disappoint. And if you're trying to wonder what will break that correlation between stocks and bonds, without a doubt, it would have to be bad data. Bad data is going to keep pushing this bond market in the direction it's been moving in, and maybe push the equity market in a different direction.
It strikes me that this cycle is so different from the last few, where there was some sort of crisis, and then there was a massive increase in unemployment, a massive increase in defaults, there was a massive disruption in the economic trajectory. We're not looking at that kind of recession, it sounds like, from everybody's accounts, because the U.S. economy is in pretty good shape, because the labor market is so strong. If that's the case, how do you price in something that isn't so catastrophic? And it goes to Mohamed El-Erian's point about, the era of crises and perma-crisis, and how you sort of get out of that mentality into something that maybe looks different.
Great piece this morning from Mohamed on Bloomberg Opinion, the risks of extrapolating out understandable euphoria.
Yeah.
There's a lot of risk around that story, a lot of risk around this story. I want to pick out a single name for you before we get moving. Pfizer was down about 4% in the pre-market. It's now down about 3% and change. This is the story for them this morning. Dropping development of its experimental weight loss pill after more than half of patients in a mid-stage study had to stop taking it due to side effects. Lisa, not very pretty side effects either.
No, we don't have to get into it. It's pretty early in the U.S. hours. There's a question here, though, with Pfizer and the big move. First of all, yes, how much of a bit lift did they get from the pandemic, given that they were the forerunner with the vaccine? But aside from that, the fact that an experimental drug being pulled from the experiment causing this type of move in a massive stock shows the hopes and the dreams around some of these weight loss drugs and what they can do for profit.
It's why Lilly is up. It's why Novo Nordisk has absolutely ripped year to date. More on that in just a moment. Here are the scores this Friday morning, December 1st. Equities going absolutely nowhere on the S&P 500. I get so excited about Christmas, Bramo. Month of December.
How's the
so
tree?
Important to me. Tree looks fantastic.
Mariah Carey?
Mariah Carey's going on a little bit later.
Oh, yeah. You haven't done it?
I have not played Mariah just yet. That will happen today. I waited because you all had a go at me for putting the tree up.
You felt shamed?
Too early. I felt absolutely shamed, yeah. I felt really sad. I'd sit there at night crying, upset, looking at my Christmas tree lights.
If you want to listen to Mariah Carey,
thank you.
I think that
Appreciate it.
You should enjoy it.
TK's putting up the tree today.
Is it? No, he's not.
TK,
He puts it up December 21st.
TK goes to the local school drops a significant amount of money on a Christmas tree, just a virtue signal to everyone about, whatever, then puts it in the corner of the living room and doesn't do anything with it for 3 weeks. Just sits there.
It's the scent. It's the spirit.
I don't think there's much spirit going on there whatsoever.
I hear you.
That's stocks. Here's bonds. Big move last week. Big move last month. Yields down 40 basis points at the front end, down 60 on a 10-year. Over the month on a 10-year at the moment, Lisa. 434.17. Yields up just a single basis point.
I know you're going to be excited about this. 10 a.m. we get ISM manufacturing as well as U.S. construction spending. But we've been talking about the manufacturing recession that's been well underway for more than a year. That sub 50 read on the ISM manufacturing index. Does that continue to deepen? Is this the pain that people are feeling that belies the strength that keeps going in the services spend? Throughout the day, we do get Ward's auto sales in the U.S. Curious to see the pricing points as well as just the sheer volume at a time, where we heard yesterday from Ford that they are expecting prices to drop, that they are seeing a bit of a retracement from some of the enthusiasm, the euphoria in this industry. At 11 a.m., Fed Chair Jay Powell, everyone is listening in to both of his two opportunities to speak today in Atlanta. Will he push back on the market euphoria? Will he say, we're not going to cut rates, cut it out? Or will he say, we continue to monitor the data, we're careful, we're looking at everything, and, let's carry on?
Maybe the latter.
Just
proceed carefully.
Yeah, proceed carefully.
For the 50th time this week. Does he have to clean up what Governor Waller said? Jeff Yu of BNY Mellon insinuated he does, that maybe if Waller had another go at that, he'd edit what he had to say.
Well, do you think that the market move that we saw off the heels of Waller is problematic to the Fed's goals? Or is that not really affecting the economy to such a degree, and are the risks balanced enough that he doesn't really care?
They haven't shown any concern whatsoever about the easing of financial conditions. Whatsoever. They could come out and make a statement about the risks of the premature easing of financial conditions. I have not heard that from anybody. Even for that matter, from the hawks on the committee, I've not heard that. They've not pushed back at all.
That's important to me. That's actually something that tells me that maybe they're not that worried, or they're more worried about the downside risk in the economy. And if that's the case, then Fed Chair Jay Powell does not need to push back as aggressively, which tells you quite a bit about where they see the softening going down the line.
Let's get to the opinion of Skylar Montgomery-Koenig, the macro strategy director at TS Lombard. Skylar, let's go straight there. Chairman Powell a little bit later. Any different to what we've heard all week from Fed officials?
No, I don't think so. In terms of the last Fed meeting, we got this very dovish impulse for the market because we had yield rise so much that the Fed said that it could account for maybe a hike, and so they didn't need to do any more tightening. And from there, the market's really run with this idea that we're at the end of the tightening cycle. I think certainly we're at the end of the tightening cycle. We have inflation come down remarkably, and it looks like to the Fed that it's on a trajectory back to 2%. So for them, they don't have to worry about inflation as much. They worry about the economy more now, the other side of their mandate. And if FCI easing supports the economy, and it means they don't have to worry about unemployment rising, then why would it be something you'd fight if inflation is on the trajectory that you want already?
What's the bigger risk right now in your view, Skylar, that we do get some sort of reacceleration in inflation, or that we get a faster than expected deterioration in the fundamentals of the economy and we get a true recession earlier next year?
I think the bigger risk from a probabilities perspective is probably an inflation reacceleration. I think what we've seen in the last few years that we didn't see for the past decade was that inflation is more volatile. Geopolitics has come to be much, much more of a risk in terms of how it feeds into energy prices and inflation more broadly. And the consumer's been very resilient, and we're having real wage gains now. And so while I don't think it's my base case that we get an inflation reacceleration very, very high that starts to worry the Fed, probabilities wise, I think I'm more worried about inflation coming back and a shock to the inflation trajectory than I am to the growth side of things.
Based on that risk being greater in your view than a recession, do you think that this market is priced to perfection in terms of pricing out that type of reacceleration in inflation?
I think, the market, if you look at long-term inflation expectations, it's a different thing than break-evens, right? So if you look at 10-year break-evens, they essentially trade what the oil price is doing. So they're not giving you a huge amount of information. But inflation swaps, so 5-year, 5-year inflation expectations that look at the longer-term trend, they've dipped a little bit more recently, but they've been on this upward trajectory despite the fact that we've had inflation coming down since the summer of 2022. So I think the market is looking for that. And, it is looking for the cuts on the back of it that imply a soft landing rather than recessionary cuts as well.
Scarlett, given the moves we've had, the highly correlated moves we've had over the month so far, can you suggest for our audience where they might go for some kind of uncorrelated diversification, given that we've just witnessed a massive everything rally in stocks and bonds?
Yeah, it's really hard. This is the issue both in terms of the 60-40 on the up and the down, right? The reason you want to be in a 60-40 is because it provides you diversification benefits. If you're rallying at the same time as well as selling off at the same time, yeah, it's great. You can be allocated in both fixed income and equities, but it's not providing you diversification benefits. I think, the only other place to look is alternatives, both in terms of energy as well as the gold price. Gold is an issue right now because it's completely decoupled from where yields would imply it is, so it's very, very elevated. And then energy prices, you're stuck between the slowing global demand story on one side and then OPEC cuts on the other side. And so it's just a very hard environment. And, you have to look at those alternatives and kind of your real assets if inflation is the worry for the 60-40, but there's not a lot else out there.
Can you get some geographic diversification within equities? Have you seen any of that in the last 12 months? Is China the place to be?
I wouldn't say China. I think for us, we see U.S. exceptionalism continuing.
Okay.
There are 5 main reasons we see that. The U.S. is less exposed to manufacturing. It's less exposed to China. Industrial policy is favoring the U.S. And actually, it's in China, it's to the detriment of Europe. I think you've actually seen, the magnitude of tightening in the U.S. has been larger than elsewhere. But, what you've actually seen is that the tightening, I think, is, not as much as it has been in Europe. So, the other final thing is kind of your fiscal outlook. And so for me, when you're thinking about the U.S. versus other regions, the U.S. is going to continue to outperform. And then just on the China point, if you think about the world's global growth engines, it's the U.S. and China. China is an L-shaped recovery. You're bottoming in activity, but you're not rebounding. It's a consumer, domestic-oriented led rebound and stimulus. And so the Chinese economy isn't feeding into the rest of the world and developed markets in the way that it has historically or in recent cycles. And that means that the U.S. is your marginal provider of growth. So it's hard to beat that if you're getting any growth that you would get from there.
It's such a great point. The US keeps winning. Scarlett, thank you. Scarlett Montgomery, Koenig of TS Lombard. The US, Lisa, keeps winning.
Yay. I mean, this is the reason why we heard from Jeff Yu that we could see parity next year. I think about all the people who tried to go to Europe first, who tried to go outside of the U.S., and it was sort of the bold...
You're saying they should have waited until the next summer,
well,
if Jeff's right.
If Jeff's right, maybe we've got to push that out to 2025.
If you are just joining us, welcome to the programme. Your equity story, the scores look like this on the S&P, pulling back by 0.1%. Yields a little bit higher by a single basis point, 434. Lisa, there's the FX market, the euro. 108.93, BNY Mellon looking for parity next year.
Yeah, and that really on the heels of the ECB cutting rates first. I do want to just go back to what we were talking about earlier with respect to Fed officials and how much they're going to push back on the market move. John Williams, who's really thought of as a key voice, New York Fed president at the Federal Reserve, said yesterday, "I'm not losing too much sleep over how markets have shifted their views." He doesn't seem to care, which raises this real concrete question about what the incentive is for Fed Chair Jay Powell to come out and push back against a market move that no one seems to care about, even though they cared about the other direction, right? Yields going materially higher, stock market selling off. That was a problem, and it could be tightening that overwhelms the potential rate hikes in the future. Not the other way around. That's important. That's telling us something.
They're responding to this asymmetrically.
Yes.
Yeah.
Correct.
No pushback at all. Coming up on this programme, Bloomberg's Anne-Marie Hordern in Washington. AMH just around the corner as the war between Israel and Hamas resumes. That conversation just around the corner. The broader price action, equities pull back just a touch by 0.1% on the S&P 500. What a run we've seen in both the equity market and in bonds. Stocks up, double-digit percentage point gains for the Nasdaq over the last month. In the bond market, yields aggressively lower, down 40 basis points plus on a 2-year maturity, down 60 plus on a 10-year. What disrupts this everything rally? Chairman Powell coming up a little bit later from New York City. Good morning.
You're trolling folks and trying to find migrants to play political games to try to get some news and attention so you can out-Trump Trump. And by the way, how's that going for you, Ron? You're down 41 points in your own home state.
He's just throwing stuff out to see what sticks against the wall. This is a slick, slippery politician whose state is failing. People are leaving his state, and he's trying to run interference for his failure.
There's one thing in closing that we have in common is neither of us will be the nominee for our party in 2024.
What a debate yesterday evening, a sharp debate on Fox News. Governor Gavin Newsom of California, Governor Ron DeSantis of Florida facing off. Joining us now down in Washington, D.C., Bloomberg's Anne-Marie. AMH, you sat through it all. Walk us through what stood out for you.
Well, I think the first thing is that there's a lot of mudslinging between these two individuals. But I think the key part of what Newsom wanted to drive home, and he did it right at the opening there, is he wanted to bury Ron DeSantis as being the Republican candidate. So really, he was carrying a lot of water for Biden and Harris, kind of going into enemy territory here because he was on Fox News, even though he has some kind of special relationship, I think, with Sean Hannity. And you've alluded to this as well, John. These two seem to like each other. And Newsom's actually the one that I believe was at least a year ago called for the debate, saying, I'm happy to debate you, Governor DeSantis. So when he said neither of us will be the candidate for 2024, that was really the first shot thrown. But they covered a lot of topics, which we don't normally get in the presidential debates because there's so many people on stage and they're all trying to vie for their moment to shine or to have this breakout moment. Here they covered everything from abortion to taxes, the economy, crime, immigration. Didn't exactly get a ton of substantive debate, more just I don't like the way you're doing it and trying to defend their records. But potentially we'll see more of these, and I think it gives a little bit more insight of what we can see maybe in 2028.
A credit to Sean Hannity for making it happen, first of all. Anne-Marie, to your point on Governor DeSantis, what did he get out of that last night, going forward and trying to take on the former president?
So going into this, I really thought that Newsom, it was a win-win. He's going into enemy territory, so people on his side of the camp, Democrats, will say this is great. He's out there fighting the good fight for the Biden-Harris administration and their campaign. So he looks like a winner to his side, and he was elevated by the fact that Governor DeSantis is not just a governor, he's a presidential nominee. In some polls, he's second to former President Donald Trump. But so it felt like DeSantis was elevating Newsom, and he didn't have to do that. Why was he going on a level with someone who's not even a presidential candidate? But I think for Governor DeSantis, this was a moment where he wasn't fighting other Republicans on stage to get his voice heard. He had a lot more time to explain his positions and speak directly to an audience that he wants to go out to vote. And of course, it comes 6 weeks before Iowa, where he spent a ton of money and a ton of political capital and time to try to win that primary.
Did they speak about foreign policy at all?
Foreign policy didn't really come up a little bit when it comes to what's going on in Israel and the Americans there. But I would say this was framed by Sean Hannity to be a domestic debate. It was about red states versus blue states. And I'm wondering if potentially we'll see more. Maybe Governor Abbott debating Gretchen Whitmer. Who knows? But it really was about how do you govern your state and the policies you're putting in place. And it started with, and I was preparing for this to start with, because this is what Sean Hannity started his sit down with Gavin Newsom. Prior, it was about the migration we've seen out of California, people leaving California, which for the first time ever happened in 2020. And of course, Gavin Newsom became governor in 2019.
The reason why I ask Anne-Marie is partly because it seems like President Biden is fighting in his race much more on a foreign policy perspective right now. There seems to be a real shift in tone when it comes to Tony Blinken, what he said to Israel over the weekend. Now what we see in terms of what the U.S. is saying about Israel's actions in the reignited conflict, in the reignited war between Hamas and Israel. What do you make of that? And how much is that really kind of where President Biden is in terms of how he moves his campaign forward?
Well, this is what the administration has to deal with, less so the campaign at the moment. But the administration is dealing with two conflicts in the world right now. And obviously, you have Secretary of State in the Middle East, and you have a resumption of the fighting, so that the pauses we see, the tactical pauses or truce, whatever you will, for the a week long, that we've seen hostages out of Israel and prisoners, hostages out of out of Hamas's control back to Israel and prisoners in Israel being freed, that has come to an end. So this is obviously going to be front and center for this administration. And it's a good point, Lisa. We did see a much tougher tone from Secretary of State Antony Blinken. Nick Wadham said to me yesterday, it was almost like he was airing to the press that he had read the Riot Act to Israel's war cabinet, saying the mass amount of civilians we saw in the north cannot be done as it is widely expected for the Israelis to go into the south part of Gaza.
So let's talk about policy. For a lot of people from the outside looking in, there is a clear and obvious division within this government between the president and perhaps within people within the State Department. Anne-Marie, that's just the government. And then you've got a massive split in Congress within the Democratic Party. So can you talk to me how on earth we come up with any kind of agreement early next year to give aid to Israel, to give aid to Ukraine? What is that going to look like in the next few months?
Yeah, it's a great question. And we heard Admiral Kirby talk about this because really for Ukraine, they would need something to be done before January, before it starts to become a little bit more of a dire situation for Ukraine because those funds that the president can draw down on are dwindling. We don't have a vote yet in the Senate. The Senate is working on a package that would encompass all the foreign policy concerns, but it would have to also include something on the U.S. southern border. And the thinking here is the way you can get more individuals in Congress to sign up for aid to Ukraine is to make sure that there is work that's being done and aid sent to the U.S. southern border. But the timeline is tricky. I mean, the biggest story for Congress today is going to be whether or not they expel George Santos, the representative from New York's 3rd Congressional District. But they don't have a lot of time left. So if this lingers into early next year, it could be quite problematic. The other big debate when it comes to Israel in Congress is whether or not they want conditions attached to that aid that the president asked to send.
AMH, appreciate the update down in Washington, D.C. Anne-Marie, more from AMH through today on Bloomberg TV and on Bloomberg Radio. Bramo, before we get lost in the glitz of a presidential election next year.
Glitz?
Before we get there, all the headlines, all the attention, the big crowds, we've got to focus on making policy at the start of next year. We've got to find some kind of agreement over spending, good luck, some kind of agreement over sending aid to Israel. Given the split within the president's party, that's going to be difficult. And then some kind of agreement over providing aid to Ukraine, which is a war which hardly gets talked about now in this country, given what's happening elsewhere.
You know, this is sort of the unspoken secret, but very well known by everyone, that in all of these campaigns, the uglier and more contentious they've gotten year after year, nothing's actually getting done in terms of moving forward certain important policies, including, for example, coming up with actually good cost cutting that can reduce the deficit, that comes up with a coherent foreign policy that a lot of people, critical mass, can get on board. And it raises this question, especially with a House that's been in disorder and that still sort of has tenuous leadership, a question of what can get through, right, at this point. So, yes, you raise a point. We have to get things done. But do we? Because it really hasn't been a problem going back. I mean, it's just sort of a can-kicking exercise for a number of years.
And deficit problems don't go away just because rates have gone from 5 to 4. They just don't. The
They're a lot
numbers are
less,
huge.
though. I know,
sure.
no, I hear you.
But the numbers are massive.
They are massive.
They're massive.
And they're not necessarily going to be making cuts anytime soon. And the truth is, whether it's Democrat or whether it's Republican, any kind of proposal that comes out to cut costs, nothing actually addresses the main cost absorbers. So it's not clear that there's going to even be the conversation unless there is some sort of bipartisan effort to really tackle this head on.
Granted, it's better that it's not at 5. And
I was going to say, I mean, how many
I'm
billions and trillions
sure,
did it reduce from the
Based
next
on how
10
much
years
debt
of interest payment?
We're issuing at the moment. That's a
Makes everyone
big
much
saving.
better.
Coming up shortly, Kennedy Goldberg of TD Securities on interest rates. We'll be talking about this equity market rally as well. What a rally through the month of November. Equities right now pulling back just a touch. We're down 0.1% from New York. This is Bloomberg. Equities pulling back, down 0.1% on the S&P 500. Who cares after the November we've just had? I said yesterday, I think equity bulls just did not want last month to end. Just let it continue, November forever.
I mean, it felt like forever, so, maybe
Double-digit percentage point gains on the NASDAQ 100. down just 1/3 after a monster move last month. Biggest move since the summer of 2022. On the equity market, on the S&P 500, again, biggest move since the summer of 2022 on a monthly basis. I will say on a weekly basis, though, this Nasdaq move has stalled a little bit. Just slightly negative, Lisa, on the week.
And I'm sure people are crying because some of the 500% gains on NVIDIA are now 498. But here's the thing. I mean, honestly, one of the reasons why I'm always a skeptic, right? I like being a skeptic. I sort of question things.
We love you for it.
Thank you. But part of the problem is that, there is actually some numbers. There are some numbers that underpin this. And actually, some of the tech companies seem to have real promise and are cash cows. So it's harder to push against this and say it's simply euphoria or a dot-com bubble in the same kind of way. So you don't really hear that type of discussion as much, even after something that seemed implausible just a couple months ago.
NVIDIA's making real money.
Exactly.
To put it that way. Top performer on the S&P. Real money. This bond market move, though, what's changed? From 5.26 on a 2-year last month, from 5.02% on a 10-year last month, down to 4.69 and 4.33. What's changed, Lisa, in a month?
Disinflation data, the fact that people feel better, maybe that there was enough stability to get all of the long-term buyers to come back. It is notable to me that some of the buyers, like Ian Lingen, like Bob Michael, were really bullish on bonds, but weren't getting into them because they didn't have the confidence of the technicals behind them. So maybe yields came in, everyone bought, and then yields came in further. So the narrative changed, the mood shifted, we all feel better. Does it stick?
Price changes narrative pretty quickly, right?
It
Quite
does.
fast.
It does, yes.
It's been quite a shift in the last month. I'll finish on foreign exchanges. Yields dropped. The dollar's had a tough one the last month. The dollar's had its worst month, going all the way back to last year, I believe. The euro, decent month, 108.96. But for how long? Pulling back recently, and we caught up with Jeff Yu of BNY Mellon. They're talking rate cuts over in Europe now, and Jeff Yu's saying, guess what? ECB goes first. And as they go first, hello parity all over again on the euro. As soon as he said it, I was sitting there like, wow, we're doing that again?
I didn't have really a good response. I was just sitting there saying, that's a bold call. What was going to back it is interesting to me, the idea that the ECB could potentially cut first. And we had 3 guests on this show this morning who said that they believe the ECB is going to cut rates before the Federal Reserve. And this comes when just a couple months ago, people were saying the ECB was on hold until 2025. There has been a shift in the data and a shift in the narrative showing faster disinflation than many people expected, both in the US, but also in Europe. And that has shifted a lot.
It reminds me of a conversation 10 years ago. I remember the summer of 2014, and we were talking about who would hike first, Carney at the Bank of England or the Federal Reserve. And we were convinced after he did this speech that it would be the Bank of England, and it wasn't. It wasn't. Sometimes you can be very wrong about these things. Maybe we'll be very wrong again. Under surveillance this morning, Israel resuming its war against Hamas after efforts to extend the truce failed. Secretary of State Antony Blinken was in Tel Aviv looking to extend the agreement when fighting resumed. Blinken also met with the president of the Palestinian Authority during a visit to the West Bank. Blinken will remain in the Middle East as he heads to the UAE for COP28. We've been talking about a fragile truce. It was exactly that.
Yeah, especially after each negotiation lasted longer and longer, and there were questions about how many of the hostages are still alive. Going forward, there's going to be a key question around where the sort of pressure comes from in terms of global leaders and how they're trying to maneuver behind the scenes, because right now it seems like for Israel and Hamas, the objectives are clear, and the objectives are to continue this war. But with respect to what some of the other players want, in particular the Middle East, they want stability, and the U.S., President Biden wants to get reelected and is trying to figure out how to do that. So that's sort of the counterbalances here.
We were in London in September. We caught up with some oil guests. Triple-digit crude by Halloween. Do you remember the calls?
Yes, I do.
That was September. Then you get an extra layer of geopolitical risk in early October, and people are thinking crude's going higher. October, down 10.76%. November, down by 6.25%. Crude, lower, back into the 70s and maybe going even lower than that. Oil traders totally unimpressed by the latest moves by OPEC Plus as voluntary cuts failed to boost prices. After its virtual meeting, OPEC announcing an optional cut of 900,000 barrels a day from January. Saudi Arabia extended the current 1 million barrel a day cut through the first quarter of next year. And here in the US, output hitting a record high of over 13 million barrels a day for the month of September. So Lisa, this word voluntary seems to be the word that a lot of people are fixated on. These are so-called voluntary cuts. Does that mean they don't get delivered?
Yeah, well, I'm sure that somebody else can answer that better than I. This was a meeting that was delayed by 4 days. It was then virtual. And then they came up with language that was highly confusing amid a lot of questions around Angola and Nigeria and their ability and willingness to meet some of these thresholds. Right now, the pressure on cuts, though, raises a bigger question, which is oil still the barometer for global growth that it used to be, given that certain modes of energy are really shifting? And if so, whose energy demand? Is this really just a barometer on China, given the fact that the U.S. is getting increasingly energy independent based on how much production is coming out here?
Without a doubt, output in America is just amazing to see, and amazing to see the White House sort of like
dance around
not talk about it at all. Crude lower over the last month. Pfizer lower this morning. The stock is down by almost 4%. The latest on that company this morning, the news there, stopping development of its experimental weight loss pill after side effects forced more than half of the patients, more than half, taking part in a study to stop taking the drug. Pfizer, of course, has fallen significantly this year as the pandemic fades. The weight loss drugs made by Lilly, Novo Nordisk, you can see the gains, Bramo. Lilly up by 61%. Year to date, Novo up by 47%.
Yeah, and yesterday, what did we hear? Ozempic is the new artificial intelligence in terms of
new AI
transformation.
The new boom.
Yeah, it's the new boom. At a certain point, though, how much can we really innovate? These were pills, not injections, and that's the reason why people had hope for them, because people could take them more easily. There are a lot of potential risks here, and we've heard this again and again. Ozempic face, different types of side effects.
What's Ozempic face? What is that?
It's when, like, you lose a lot of fat from your face,
like
and then
gaunt.
it gets gaunt, and then there's sort of wrinkling under the eyes. I was looking at this yesterday. I heard about this. I'm not the expert on this. We're going to be speaking with Sam Vazzelli later. He can explain what Ozempic face.
You said it, so I thought you'd explain it.
I'm going to let that hang there.
Sure. Gennady Goldberg joins us now, head of US rate strategy at TD Securities. Good morning.
Thanks for having me.
Gennady, let's talk about what's happened in this bond market. Can you tell us, please? I get the price change. We can look at a chart. What's actually changed fundamentally to get us here?
I think it's the data. I think all of 2024 is going to be this struggle, especially in the early part. It's going to be this fight between supply and demand, which we know is still very much out of balance, and the market's sort of forgotten that at the moment. But the data has turned, right? You're starting to see soft data, hard data, inflation data, all surprising to the downside. I think that's the big driver, and the market's gotten into its head that no hikes equals cuts. And I don't think that's quite right. Speaking as a bond bull, at least recently, we've been long since 470, and I'm certainly not complaining. But I do think you are seeing a little bit of an overstretch at this point. The market's not really thinking about that the data can be, less than bad. And if you see some strong data, you can certainly have a problem there.
Let's push that a little further.
Yeah.
What would make you not be a bond bull anymore? How far would this have to go?
I think if we got closer to 4%, I think I would take my foot off the gas pedal at that point. You have to play this one tactically. For the next year, yes, we expect rate cuts. Yes, we expect the data to slow. We expect a recession by the second quarter of next year. Not yet, right? This market's getting really ahead of itself. What you're seeing is a massive compression in term premium, which is very interesting to me because that's not something you typically see at this point in the cycle, especially when a month ago we were talking about who the buyers are going to be, right? Who's going to be taking down all of these trillions of dollars of treasury supply. Suddenly that's gone, and term premium has dropped over 50 basis points just in the last month. I think that's a little bit out of whack.
Which is the reason why we've been talking about the difference between 2-year yields rallying as much as they have and 10-year yields rallying as much as they have. Do you have more confidence right now in short-term bonds or long-term bonds?
I have a little bit more confidence in short-term bonds. I do think that 2 to 5 year sector is pretty attractive from a long-term perspective. I think folks are certainly getting in, which is why you're seeing that. But you're also seeing this massive repricing and rate cuts. And yes, we do have cuts next year, but again, it's going to take some time for those to actually filter through. And for that data to actually catch up to reality, you're not really seeing that at the moment. You're seeing something slow down. Let's say we get a 250K payroll print next month. What's going to happen to rates? I can easily see us back up, 15, 20 basis points just on the day.
We're going to do some scenario analysis over the next week. That will be the number one question I ask.
Oh, yeah.
What if we get 250? How does it change this bond market? You mentioned the deficit. Still massive.
Yeah.
If you can pick out the chart of what's happened with treasuries, I think you can closely identify what happened in the summer and what happened in the last month. Treasury refunding was kind of important. Now, Mark Dow is a man who I really respect. He's out on Twitter, now known as X, of course, and he talked about confusing a catalyst with a driver. Now, you could probably identify Treasury refunding as a catalyst for the turn in this market, yields up, and again, yields lower. But is that the driver of what we're seeing take place?
I think the driver is still the macro. I think it's more so the catalyst is only paid attention to when there's nothing else going on, when the data is good. That's what matters. Supply matters when things are good, when you have your choice of, the pickings, whether you can buy stocks or bonds or corporate bonds or whatever you want. When data starts to turn sour, people stop caring. It almost doesn't matter how much we issue. People want to get into safe haven assets. They know rates are going down. They're trying to make the macro play. So it's almost kind of, supply on, supply off. But we keep getting these, prints that are basically telling us the bond market's not very healthy, right? You keep getting these 5 basis point tails at 30-year auctions. It's going to be a problem for the U.S. Treasury. So speaking about catalysts, the next one could be quite interesting. If we get another 1 or 2 tails at these, 30-year auctions, maybe by February, Treasury will decide not to increase 30-year auction sizes anymore, and that could be quite bullish as well. But it is going to be whippy.
We've been talking all day about how exhausting this year has felt. We've been talking all year about that, and how November felt like a year in and of itself, which raises a question. Do you end up going into next year the way Chris Harvey is talking about it over at Wells Fargo, which is just treat it as a trader's market, lean against sort of the sort of momentum trades, try to sort of lean against the flow, and we're going to end up in the same place that we are right now? Is that kind of how you're looking at it?
A little bit. I would say lean with the flow and just be very careful about how far things are going. Realize, I think, that there's a lot of people on the sidelines, that people are piling in very last minute. So when you get that perception that, things are going a little bit too far, you want to start taking some risk off. You don't want to lean into long-term calls, very stubbornly at this point, because you do want to realize that people are going to be getting in late in the cycle, and you're going to be exacerbating a lot of these moves. So where you should have been going to, let's say, 450 on 10-year rates, you're now going closer to 4%. That's your symbol. I think that's your signal to get out if the macro doesn't support it. Keep an eye on the macro and keep an eye on the momentum, because those two are really going to whip things around.
Just how sticky is that money in money market funds?
I think pretty sticky until something really material changes. I think a lot of that money will pile into equities, will pile into fixed income at the first sign of trouble. Right now, it's still piling in. Right now, it's still
So November wasn't it?
No, I don't think so. If we continue to get really decent macro data, why not? People are still going to be earning, 5.25% to 5.5% on their money market funds. It's, duration free. You don't have to worry about losses. It's a very easy play unless something looks attractive. And the issue is right now, not a lot of things look especially attractive from a long run.
If you are just joining us, welcome to the program. Just an update on the scores right now. The equity market negative on the S&P 500 by 0.1%. Let's continue that conversation because I think it's really important. There is a view, I think, because we've been conditioned by 2 massive shocks and 2 massive policy responses to those shocks, Great Recession, financial crisis, and then the pandemic, that when the Fed starts to move, they go all the way back to zero. What do they go back to?
We think around 3%, and that's kind of a short-term neutral rate. And I think that is in their minds as well. That's the next fight for inflation, right? If they go back to zero and they do QE, we're going to be in for another huge round of inflation, and they know that. So they have to almost under-ease in the next cycle. We're thinking they go back to about 3%, so that's 250 basis points of rate cuts by early 2025. That's what we've got penciled in. If that's the case, and they're going to be very cautious about it, they're going to basically ease, but they're not going to ease excessively. They're going to get us right back to neutral, maybe a little bit below neutral in the short term, to just stimulate the economy, make sure they're not over-tightening. They don't want to ease massively. They do not want to go back to zero, even more than they don't want to talk about rate cuts.
They really don't want to talk about rate cuts, do they, Bramo?
No, they absolutely are going to avoid it, except Chris Waller, who kind of went there.
It kind of set it up, didn't it?
Yeah, he did.
I do wonder about Waller this week. How much of that he really wanted to say? Maybe it was what he was thinking. Is it what he wanted to say?
The fact that he's not losing sleep over the market's move.
Yeah, I think that's important.
Really, it is important. It tells us that the balance of risks is they are seeing a greater risk of weakness.
Gennady, great to see you. Gennady Goldberg there of TD Securities from New York City this morning. Good morning. Your equity market on the S&P pulling back by 0.1% on the S&P 500. From New York, good morning.
Magnificent Seven have had a fantastic growth year. I mean, one semiconductor company has massive growth. If you take a look at the next 9, they don't. So when you think about valuation, I'm really not taking an active bet against large cap tech to really underweight or overweight.
That was Steve Whiting there, the chief investment strategist and chief economist over at Citi Global Wealth on some of the big winners of the year. The big winner of the year, of course, has been NVIDIA. And I think everyone wants association, Lisa, with that story.
Yeah, anything to build on it, to build on the software side, because they are the hardware solution of choice. And really what people are talking about is how hard it is to get into the hardware side. So you might as well be the software side and pair with it and just ride the train.
Let's have that conversation right now. Computer hardware maker HP Enterprise joining the rush to artificial intelligence. In earnings announced this week, HPE saying it expects softer demand for servers and storage, but it's hoping its new AI venture will offset the slowdown. The plan including a bigger partnership with chip giant NVIDIA. Antonio Neri, the CEO of HPE, joining us from Barcelona, where he's been speaking to customers. Antonio, great to catch up with you, sir. Let's start with that relationship with NVIDIA. For our audience who aren't familiar with it, can you describe it to us and how beneficial it's going to be to both of you?
Yeah, well, good morning. Thanks for having me. As you see, we are in Barcelona. There's still a show going on. We hosted HP Discover here with more than 3,000 customers. And thanks again for having the opportunity to talk to you. So here at Discover in Barcelona, we announced an expanded partnership with NVIDIA. 2 weeks ago at the supercomputer event in Denver, we announced a deep solution for what we call model developers for generative AI, using our supercomputing capabilities, plus our intellectual property in the software space, plus NVIDIA chipsets, and other aspects of what they do to provide a massive capability for model developers to speed up the training models. And here on Thursday, I announced an extension of the partnership for enterprise customers to what we call fine-tune those models and accelerate time to value, using our expertise as well as our services capabilities and the software to be able to deploy it on premises and at the edge. So this is a complete solution for what we call the AI lifecycle, from training to tuning to inferencing. And customer has a massive reception because they want to privately fine-tune the models with their data in a secure and compliant way.
It's clear your stock is benefiting from the glow of NVIDIA. We can see that. I think Raymond James writing that you're getting a seat at the AI table. Can you talk to us about the pace of adoption of this technology? I think many of us, Antonio, are surprised by some of the guidance we had repeatedly from NVIDIA, that this wasn't just a hopeful story about the future, it was real and present. Can you talk to us about that?
Yeah. Well, I think there's two components, right? So the story is absolutely real. We see it in the quality of the dialogues with customers, which are now accelerating the model training. So you think about this, at the beginning of 2023, we had less than $100 million, what I call accelerator processing units in our server business. At the end of 2023, we grew that business to $3.6 billion in orders. And that was literally in 10 months. And the reason why that's happening is because the technology has achieved an inflection point where it's ready to be deployed. However, our story is not just AI, just to be clear, Jonathan, Lisa. Our story is a combination of a hybrid cloud, a cloud-native world, and an AI-native world. Think about it this way. Most of our data today sits in the cloud-native world, whether it's in your premise, in manufacturing floors, in hospitals, and obviously in the public cloud. But AI needs that data, is hungry for that data, and therefore now we need an AI-native architecture to train and fine-tune these models with that data and then put it in production, which ultimately is the value to change your processes and be able to achieve those outcomes. And we deliver all of that to our HP GreenLake platform. And that's why we see a tremendous growth in our connectivity business, in our hybrid cloud business, and then obviously now in AI. And we have a unique portfolio to address all aspects of what customers need.
Antonio, this year we've been talking to so many people who talk about a winner-takes-all type of trend in tech in particular. Amazon's AWS, Microsoft's Azure taking an increasing part of the market share. How do you compete at a time where people seem to be gravitating toward the biggest players?
Well, there is an interesting opportunity here because obviously the last decade, think about 2010 to 2020, was all about the cloud decade. You know, the cloud for us is an experience, is for accelerate speed and agility across the business. And now we enter what I call the new age of insights. And it's all about deriving insights from the data and changing the way you do business. But that inflection point actually requires a different architecture. And therefore, customers are not keen to put the public data the data in the public domain and make sure that they control that, because that's intellectual property, and that creates a massive opportunity for us. And we think of HP GreenLake as the fourth cloud. It's a design for hybrid, meaning you can take advantage of the public cloud, but also take advantage of the on-premises and more at the edge, and be able to do everything you need in a unified experience. And that's the value that we bring to the table. And ultimately, we have every aspect of the solution stack and the partnerships, like we did this week with NVIDIA, to give that unified experience.
We've been hearing all about consolidation in big tech. How much are some of the biggest cloud providers trying to get into that market, where it's basically the hybrid, trying to have bespoke solutions for companies versus having the market to yourself?
I mean, the market is big. I think, we're talking about over $1 trillion market opportunity from an IT perspective. And I believe AI opens an incremental $1.6 trillion opportunity for everyone. So there is plenty of market out there. And you think about us as a company, this year we grew 5.5% in revenue. We expanded gross margin very rapidly thanks to the mix and the value we bring to the table. We achieved record-breaking performance in non-GAAP, diluted net income per share, and free cash flow. And we believe there's plenty of runway here. But ultimately, the winner is about all delivering a simple experience where technology is easy to deploy and consume, and ultimately accelerate business outcomes. It's not just about thinking about technology and speeds and feeds. It's about delivering that agility to deliver those business outcomes. I think HP is uniquely positioned with the fourth cloud, I call it, HP GreenLake.
Too much tech. Let's finish on football. Are you happy that Messi is no longer in Barcelona and we have him here in America now, Antonio?
Well, I'm happy that Messi is Argentinian, and I was born in Argentina, and I had the honor and pleasure to meet both of them. In fact, I was able to play one time a game with Diego Maradona, and I have to say, for us, it's an incredible pride. But obviously, having him in the United States gives me the opportunity to go watch him more often.
Amazing. I want to hear that Maradona story one day. Antonio, thank you. Antonio Neri there. If you look back, thank you, sir, on the latest. Just got a note from Citi I want to share with you all just quickly on the pushback we can expect from Chairman Powell a little bit later. Just in summary, Lisa, not much of a pushback, Andrew Holdenhorst says over at Citi.
And this is partly because, frankly, he hasn't. And he basically will say that they're not indicating any discussion around rate cuts, but it's not going to be the massive shutdown, the throwdown with the market saying, guys, stop it, because it doesn't seem like they care that much about the loosening of financial conditions.
No, not at all. And they did care, big time, 12 months ago. I always go back to that speech. Chairman Powell, Jackson Hole, August 2022. We'll get inflation down. It might be painful. It'll be more painful if we don't. And we're still sitting here saying, okay, where's the pain? Where's the pain? That's what has surprised so many people, to see inflation come down the way it has done without the economic pain. I think what's interesting about the last month we've just had a 60 basis point move on a 10-year yield. It's the biggest monthly move going back to March. But March, as we indicated on this program a little bit later, was about hard landing nirvana. And the last month has been about soft landing nirvana. And the pushback against the soft landing stuff that you hear all the time is that it always looks like a soft landing until it's a hard one. Christian Mamani, Lafayette College, yesterday.
I heard that.
Brilliant,
that was great.
Brilliant. Came out with this line. He said, yeah, but John, it also looks like a soft landing when it's a soft landing. So who knows? What did Neil Dutta say? Glide path. He talked about a glide path, right? He thinks we're on a glide path to rate cuts.
As soon as March. That's right. To me, it seems like November was the month that we reprised transitory without saying transitory. And to me, it seemed like we pushed back a lot of the expectations from the end of last year. And to me, transitory is sort of the subtext to all of the moves that nobody will ever say because it has been dragged in the mud and tarred.
Transitory for longer.
And basically that the period of time where inflation was elevated lasted longer, but that ultimately we're going to go back on a year-over-year comp basis. Nature is healing. All that. I
get nervous when people start saying things like that. But yeah, that has been the last month.
Yeah.
Let's just say that's a judgment about the past and not a call about the future.
Are you trying to do the fine print?
Just
You're
in
doing
case.
The fine print on the bottom?
Absolutely.
I think that's right.
Just a small disclaimer there. Coming up in the next hour, Liz Young of SoFi to weigh in on this market. This market right now, equities negative by 0.2% on the S&P 500, pulling back just a touch after a monster move month to date on the Nasdaq, closing out the Nasdaq for a double-digit percentage point gain. Can Chairman Powell spoil the party as we kick off December? Chairman Powell coming up a little bit later.
line, inflation is coming down faster than they expected. We think that the Fed's last rate hike was July.
They're going to want to be careful about having restrictive monetary policy.
A policy error would be that they tighten policy so much that inflation falls too much.
I do think that the data is lining up, and we're on a glide path now to a rate cut.
Well, it's not that the Fed can't ease next year. I think the debate right now is when are they going to ease.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Music to the ears of equity market bulls from Neil Dutta there of Renaissance Macro on a glide path towards rate cuts from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market pulling back just a touch by 0.2% on the S&P 500. The everything rally has absolutely dominated everything on this program, Lisa, for the last month.
And we keep repeating this one stat, 9.6% gain on the 60-40 portfolio put out there by Bank of America, Michael's Hartnett. The biggest gain going back to the dissolution of the USSR in December of 1991. It gives you a sense of history and how unusual this type of move really is, John.
How far can this move go now? Mike Schumacher, Wells Fargo, on a little bit later. He thinks the limits to this 10-year move, 4%. 4%. 4% is like maybe a day's price action based on the moves we've seen over the last week. 10-year right now is 4.33. So if Kelsey Barrow's right over at JP Morgan, that was the last hike back in July 26th, 387 at the close on a US 10-year, 387. So now it really is about, do you see growth and inflation continuing to fade? Do you see this Federal Reserve cutting anytime soon?
I thought that Gennady Goldberg put it really well, where he basically said that we're being whipsawed between the economic data, which has come in weaker than expected when it comes to certain economic indicators as well as inflation. And then you also have just the momentum trades that are whipsawing things to take them further than people previously expected. So now do we hear more about levels? Thresholds, things like that people are using for triggers. What this says to me is we're going to be in this bouncing kind of sphere for a while. We're not going to get back to that sort of direct trade that's going to last more than a month or two.
I think there's a chance we're confusing a few things. Savita Subramanian of Bank of America said it's not about what the Fed's going to do, it's about what they've accomplished. And I don't think it's necessarily about the weaker economic data, it's what the stronger economic data didn't do. So that you can have a Q3 with GDP north of 5% and inflation doesn't accelerate. That you can have unemployment still below 4%, jobless claims around 200k, and wage growth isn't going through the roof. That you can have this very, very decent, in fact brilliant, rebalancing of the labour market, supply and demand, without a recession, without a big economic downturn. That is what I would argue this market has celebrated. Now, whether that continues, I've got no idea whatsoever. But I think it's a stretch to say that we're seeing weak data. I don't see weak data. I don't see that on the surface at all. It's what I don't see off the back of strong economic data. This US economy has been so much better this year than people expected. And yet inflation. If I said to you, start the year, Q3, north of 5% GDP, what's your CPI call?
CPI call would be north of 5%.
Okay, you'd expect inflation to be high. That's not what happened. So when Neil Dutta of RenMac came on the programme, I think a number of months ago, maybe a number of weeks ago, and he said the important piece of this now is the labour market is no longer a reason to be hawkish, based on the very fact that you can have 200k prints on payrolls and wage growth isn't going off into the stratosphere.
There's a lot to unpack there, and I think you're right in the sense that people are celebrating the fact that stronger economic data has not caused a resurgence in inflation. At the same time, I don't think anyone's too comfortable with the idea that we're not going to see that. Basically, especially because of the year-over-year comparisons. There is a sort of unprecedented feature to everything about this cycle, not the least of which is, yes, we haven't seen weakening, but on the margins, people don't feel good. And on the margins, people are restricting spending. And on the margins, we do see ongoing recession in the manufacturing sector, ongoing recession in a lot of the smaller companies. So when you take a look at that, it's sort of masked by a lot of strength in the adoption of all of these other things in the AI. If it sounds like a mush, it feels like a mush. And it's the reason why I think there's a lack of conviction, frankly, in the market.
Just remember, it was price gouging. All right, that's all it was. Can we get to that statement from the president? I need to do that again.
Please.
I think it's brilliant.
It is.
Who writes these tweets for the president of the United States? That's all I want to know. Who writes these tweets for the president? There's no way that President Biden is sitting there on an iPhone whacking these out. There's just no way at all. Well, what does this even mean? Let me be clear. To any corporation that hasn't brought their prices back down, even as inflation has come down, it's time to stop the price gouging, give American consumers a break. I mean, talk about politics and bad economics. Jim Bianco, Apparently, he does not know the difference between prices rising at a slower pace and prices falling. It signals he does not listen to Secretary Yellen because she knows the difference. That take from Jim Bianco implies that the president wrote it. I don't think the president wrote it. I'd love to know who did.
Well, to me, we'll try to find out that answer. Probably unlikely that we will. But to me, the real issue is, what does this signal about the desperation to try to push the blame of inflation onto someone else? Because he has gotten the blame for inflation. Not saying it's necessarily warranted. A lot of people still debate exactly the drivers of inflation. But right now, it seems like this is impeding his reelection bid more than anything else. And he's not sure how to tackle it. And that's what that tweet says to me, because a lot of people are ex post. A lot of people would just, categorically say it's nonsense.
Ex post means something else, doesn't it?
Well, it could.
Yeah, sort of ex ante, ex post. But yes, it's a post on X.
Thank you.
Which I'm with you.
Yes.
Let's get to the scores.
Excellent.
TK would have appreciated that.
I thought that was good.
Whatever.
I got it.
Futures on the S&P,
right
negative by 0.2%. We're coming back just a little bit softer, negative down lower on the S&P 500. Yields going nowhere, 432.81. Yields going somewhere, and that's lower over the last month. A monster move in bonds and stocks. The everything rally dominating the month of November. Let's catch up with Liz Young, Head of Investment Strategy at SoFi. Liz, any reason to believe, and good morning, it's always great to catch up with you, you know that, any reason to believe that this bond market, stock market correlation continues in the way it has done over the previous month, over the next 3 months?
Well, it's certainly possible. I mean, I think 2023 has shown us that anything is possible. So it's certainly possible that the correlation remains positive in the sense that we continue to see yields come down. Stocks are celebrating that, particularly growthier stocks, which I think is a rational move, at least initially. So I do think that the correlation could stay positive for a little while. What we're looking at here, especially into 2024, is that we've been wanting cooling in a lot of this data. We've been wanting the cooling in inflation. We've been wanting a labor market that gets a little bit more imbalanced. So we've seen some of that data, things like continuing claims on a steady move upwards since September. We know that the manufacturing economy is still feeling some pain. We're hearing data out of the consumer that they're pulling back on spending a little bit. So we've wanted this cooling. The question into 2024 will be, can we stop the cooling before the economy tips into contraction and makes us all nervous? If we start to get data that gets too cool too quickly, that's when that correlation between stocks and bonds breaks down, where I think you see bonds rally. So you see yields continue to fall because people got afraid, but stocks also come down in tandem.
Liz, you work for SoFi and you work on the investment wing of it, not necessarily on the financial technology aspect that caters to usually younger individuals who are trying to manage their finances and take out credit. I'm wondering, though, what you make from an economic and investment perspective of people who are doing more buy now, pay later, who are increasing their credit card bills, who are increasing on their delinquencies and their defaults.
It's certainly concerning, and it's something that I've been watching for the last few months. We've seen delinquencies tick up so far in just the subprime auto loan sector, but you've seen, as we all know, credit card debt get to really high levels. Hasn't broken yet, hasn't been an issue yet. But the thing about where we are this time of year, we talk a lot about this being a positive time of year for the market. And as we all know, the Santa Claus rally, a possibility later this year. And we've got holiday spending going on. And so far, the data from holiday spending has been maybe a little bit higher than expected. However, what happens in January and February is that if consumers were doing that holiday spending on credit, so things that like buy now, pay later, or on credit cards, the bill comes due in January and February. Now, this happens every year, but this year could be a time where we're seeing that bill come due and delinquencies tick up because consumers have been using buy now, pay later in larger quantities than they did last year.
How does that affect your investment strategy? I mean, basically, are you looking to January and February to see those increase in defaults in order to get more bearish and say that maybe the bond market could rally more, but that's going to be a negative when it comes to equities?
Well, so the bull case and a lot of the optimists have been hanging their hat on the strength of the consumer, and the consumer has remained strong. There's obviously appetite to spend. There's appetite to travel. We're seeing the consumers still get out there and spend their money both in stores and online. But over time, if the labor market cools, or if consumers really are feeling the pain of inflation and recognizing the idea that inflation has stopped growing as quickly, but it hasn't come down. So for consumers to really get some relief, you would need some deflationary prints, and we haven't gotten those yet. So if the data does start to suggest that the consumer has pulled back, or the labor market is cooling to a point that's going to cause the consumer to pull back, then that is going to be negative for equities, particularly from these levels. So watching that on a sector basis, though, it may not be a wide swath of a drawdown, right? So if yields are falling, tech stocks probably still can do okay in that environment. But then you see the pain on things like consumer discretionary stocks. You see the pain on cyclicals, because right now I think the market is in this place where we're not sure if we're going to have a cyclical expansion or not. We haven't confirmed in one direction or another, and we're sort of waiting to see.
Super difficult to make calls on this market. You mentioned sectors, Liz, so let's finish there. What are your favorite sectors going into year end and beyond?
Well, look, as yields fall, I think for the near term, at least, tech stocks still can hold up well. This is also a period of time after the last hike and before the first cut that stocks tend to do okay. So I don't necessarily see a huge drawdown unless there's some exogenous shock. But going into 2024, I think that we need, if the bull case comes true, we need some broadening out in the equity market. I am still nervous about a drawdown. I am worried that we're going to get data that cools it too much. So I would be cautious in cyclicals. So I would still be looking at things like consumer staples. I think the utilities trade is okay. If you're looking for growth, but you don't want that rate sensitivity, I think healthcare is a good place to be. And I do think that we see a resurgence in energy stocks because supply will continue to get cut.
Interesting final point. Liz, thank you. It's good to catch up with you as always. Liz Young there of SoFi in this equity market. In Stuart Kaiser's corner over at Citi, said much of the same thing. Be careful what you wish for. When the economy starts to slow down, the data goes too far, then he's going the other way, in the other direction.
Which is essentially JP Morgan's call, and they're going to be pilloried because of how far they're going with exactly the 4,200 price target. Nonetheless, the rationale is actually pretty consistent across Wall Street. It's just a matter of how that translates to markets.
If you're just joining the program, welcome. I'll get you up to speed on the scores briefly. On the S&P, we're negative here by 0.2%. We talked there about the consumer spending, the retailers. Let's breathe some life into that conversation. Buy now, pay later. What is more important to you? How much consumers spend or how they spend? This in the Journal this week, citing that data we've all been talking about from Adobe. The trend of consumers using buy now, pay later options reached a record high. Cyber Monday, contributing $940 million to Monday sales. That is a 43% surge from last year. They are big changes for buy now, pay later from last year to this year.
Two things. One of them is there's a cohort of people who don't want to partake in the credit card sphere, so they're increasingly going to buy now, pay later.
Or can't.
Right. And basically this is a way to not pay interest, but also not necessarily feel like you're committed in that kind of way. But second of all, this really raises a question of when the bills come due and whether people are stretching beyond their means by adding lots of smaller payments to their monthly load that all start to accumulate in a way that can become suffocating.
Can we buy trucks, Cybertrucks, buy now, pay later?
You might have to wait until 2025.
For the cheaper option?
For the cheaper option, yeah. And you could buy a decal that shows the smashed window.
I saw that. How much is that?
$55.
I can afford that. I'll pay cash for that.
Yeah, but you're not going to put it on Tesla trucks because it's not coming until 2025.
I don't know about the truck. Let's have that conversation with Dan Ives of Wedbush. What an achievement to finally get some customer deliveries for this beast. Speaking of the cyber beast, we'll talk about that as well a little bit later. That's a model name, isn't it?
Yeah, it also looks like a beast.
That conversation up next from New York. This is Bloomberg.
We have a car here that experts said was impossible, that experts said would never be made. Tougher than bullets, tow pretty much anything, faster than a 911 while towing a 911. So, and deliveries begin now.
That's the pitch. Tesla CEO Elon Musk speaking at the Cybertruck delivery event in Austin 4 years after their announcement of the vehicle. And I have to eat some humble pie because 4 years ago, when I first saw the design for this vehicle, Dan Ives might remember this, I described it as an 8-year-old drawing the car of the future. Just these jagged lines and it looked ridiculous. And here we are, the thing looks phenomenal and everyone wants to buy one, at least the people I speak to.
You still think it looks like an 8-year-old Druid, so it's not
I do, but what do I know about car design?
Well,
because apparently everyone thinks this is the car of the future and they want to buy it.
Well, apparently Dan Ives thinks that you're a great candidate to get in one of those and drive off the lot.
We'll have that conversation right now. Yeah, Dan Ives is pitching the Cybertruck to me in a commercial break. Dan, it's good to see you.
Great to be here.
It's fantastic to catch up. This beast, deliveries. Talk to me about how transformational this might be for the company.
It's a historic moment. I mean, it's 4 years in the making, and I think the reason it's important in terms of this could be another growth vehicle for Musk and Tesla. And it also just shows what's happened. 313 area code, GM, Ford peeling back a little on EVs. Tesla is doubling down. And I think this is an important moment. And you go back over the years, many times been counted out, but yet they've come out in a flex the muscles moment.
I want to talk margins a little bit more with you, but just on the point you made, bringing up GM and Ford, are we finding out that people just want Teslas? They don't want EVs?
Look, I think it's a serious question here because, wanting an EV versus do you actually just want a Tesla? And I think you're starting to see now a moderation in terms of EV demand. Now, clearly, Tesla's had the price war that we've talked about in China. That's definitely, left a bit of a stain. But I do think from a scale and scope perspective, you look at Fisker reducing guidance again today, no one could match the scale and scope of Musk and Tesla. And I think that lead continues to further be there. And I think that's what's happened, a little humble pie maybe with traditional automakers.
Well, John Lawler was on yesterday, CFO of Ford, and he was talking about how there was a different audience for the initial Teslas because it was the first adopters. And they were willing to pay a price premium, and they were willing to come in, and they were Tesla adopters. The ones who are coming in now are looking for price, value, quality, et cetera. It is a different pool where that can be pulled away more aggressively. In that kind of environment, does Tesla's margin story start to get eroded?
I think, and John talked about it, I think right now that's the balancing act. Because if you look from a margin perspective, it's really been volume over margins. And the street, so far that's been the right strategy. Next 2-3 quarters, you need to see margins trough out, level out here. But when you look at Cybertruck, look, essentially they'll be losing, let's say, $30,000, $40,000 per vehicle for the next year and a half. Then it starts to become profitable. But that is the near-term pain for long-term gain that they need to do in what continues to be this green tidal wave.
To John's point when he's saying people just want a Tesla, I wonder how much that's people wanting to ride Elon Musk's wave and how much that was really the feeling a number of years ago. How much some of the recent high-profile discussion around Elon Musk with X, with his colorful interview and commentary toward advertisers, does that draw people in or push them away?
I think there's still a question there because to some it emboldens them in terms of Musk, what he represents. He's the anti that's I affiliate with the Tesla, but then on the other hand you alienate. And the problem for I think Tesla investors, when you sell consumer products to the masses, you don't want controversy. But again, Musk is Musk, goes to the beat of a different drum, and you see, and that's we saw that maybe overshadow a bit in terms of what happened at the New York Times event, the Cybertruck unveiling. That's 4 years in the making. But at the end of the day, Musk will continue to, I think, innovate, and especially when it comes to Cybertruck, a historical moment.
What did you think about what happened this week?
I think it's one where it's the last thing you want to see as a Tesla bull, to see something like that come and ultimately overshadow what was going to be Cybertruck. But as we all know, Musk is Musk. And it goes back to what we've talked about a lot in the show. When he bought Twitter, the $44 billion mistake, in my opinion, which now, let's say X is worth $5 to $8 billion, this is always the worry. It just adds that tornado factor. Because with Musk, if you give him a mic, you never know what's going to happen.
Sure.
And that's part of the problem here. And even though many could say, it's great, go get him. Okay, but there's a business there. It's been essentially taken out with debt. So eventually that you're going to have to pay someone in terms of what's happened with X.
I think you just put a Dan Ives multiple on X there with that valuation, but we'll come back to that another time. I want to talk about margins just a little bit more. There's a massive opportunity, if you didn't have this truck, to keep on pushing and squeezing Ford and GM. GM have come out with numbers this week, basically telling us that the labour market contract, the labour contract, would add an additional $575 per vehicle. At Ford, it's upwards of $900. Does this truck complicate their effort to really put the squeeze on Ford and GM in the way they have done over the last year?
I think it does a little, because ultimately, when you look at the UAW debacle and the 313 error code, it's put Farley, Barr, it's put back against the wall. And that adds to the cost. I think where they're going to squeeze them continues to really be on that 40 to 50K price points in terms of sedans. That's what they're going after. But that's also why Mary, and you've seen it from Farley as well, they're kind of coming back a little from the edge, not maybe going full EV, where Tesla's actually going the opposite. And that's essentially what's happening right now. This is all a game of high-stakes poker. And I think everyone's trying to figure out what Musk's next move is in 2024.
And who it's catered to. I mean, that's another question, too, because the audiences of Ford and GM much more focused domestically, whereas Elon Musk has a big audience in China as well. How much is the Cybertruck geared toward American buyers, and how much is it geared toward international buyers?
Yeah, and Lisa, that's a great point. Because, look, China, the hearts and lungs of the Tesla growth story, it is in China, 45% of demand. And I think what really he's focused on here with Cybertruck, it's, first of all, it's showing from an innovation technology perspective just how far they are. But the opportunity, even though it's starting in the US, it is international. It's Europe, it's China. And I think that's really the global focus of Tesla. You look at Ford, there's many that have kind of customers fought against going toward an EV. I'm a traditional F-150. I'm not going to go there. Dealers have fought against it, and they've heard it loud and clear in Detroit.
Do you think it's attractive?
Look, the Mad Max vehicle, and I remember when you talked about that in 2019. I think we talked about that together. I believe, I get it, it's on the edge, but I think it's innovative, it's new, and it's something where Tesla is not going to go down the typical path of other automakers. And that's why, like, look, when I see you driving this in New York about 6-9 months from now.
TK in the passenger seat.
TK in the passenger
Amazing.
seat. It's with Cybertruck, it's going to be
Can you take
awesome.
the roof off? The roof come off?
But you could be in the back as well. So it's going to be super interesting.
Am I the only one who drives?
You are.
Yeah, just.
Bramo's got to drive. TK and I don't drive.
So I'll drive. They get in the back.
And again, but Lisa could be driving. You got TK, shotgun, Barrows in the back. Yeah,
sleeping.
That's not going to happen.
All right, let's go.
Sleeping.
Dan, thank you. Dan Ives of Wedbush. On a serious note, to Dan's point, and you went there, it's BYD, it's NIO. That's the real competition here.
100%.
Can Ford and GM really even get in the game? Can they actually get in the game?
Well, which game, right? And I think that that's really the key, because they can get in the game of offering a vehicle that people would have otherwise bought that was a fossil fuel burning vehicle that was electric. If they offer a similar kind of price point, it economically works out to be less because there are the charging stations. It is a different audience than the people who go out and proactively seek out a Tesla.
This was great. Dan, it's good to see you.
Yeah, great to be here.
Thank you, buddy. Thank you. In the next hour on Bloomberg TV, Jay Pulaski at TPW, Mike Schumacher of Wells Fargo, Savita Subramaniam of BofA, Savita Subramaniam on 5K on the S&P 500 next year. From New York, this is Bloomberg.
We are 1 hour away from the opening day on the first day of the last month of 2023, which has felt like 4 years tied into one. Welcome back. This is Bloomberg Surveillance. John's off preparing for his 9 a.m. We are looking at a bit of a retracement, but it's hard to say that. Basically, people are just sleeping in after a blockbuster month where we saw the biggest returns going back to early last year for the S&P, for the NASDAQ, massive rally in the NASDAQ in particular, really led by bonds. And to me, the stat of the morning, we keep repeating it, but it's worth saying again, Bank of America pointing out the 60-40 portfolio had its best performance over the past month, going back to December of 1991. Fueling this, hopes of rate cuts. Do we get the data to potentially back that up? A slew of recent Fed speak showing some divergence ahead of Chair Powell's speech at 11 a.m. President Bostic and Harker signaling that they think the central bank has done enough. President Barkin and Governor Bowman joining the majority of officials officials leaving the door open for further hikes. I love that we have this in a chart. The fact that we are parsing through this, Michael McKee, focuses our attention very much on how everyone else is just uncertain and looking for guides. Mike, what are we expecting to hear later this morning from Fed Chair Jay Powell?
Saw an interesting headline this morning describing the markets as hovering. I hadn't heard that term before. Hovering over Jay Powell. You're going to hear the same thing that you've heard from Jay Powell before, and that's why I put him on the list of people who think that they've done enough for the moment, but keeping their options open, because that's what he has said this month. Even after the Fed decision on November 1st, he said that we're going to be cautious about not getting faked out by 1 month's data, but we are going to raise rates if we need to. And so I think you'll get more of that today if he wants to say anything at all. I assume he does because there's so much focus on it that if he didn't, maybe somebody would read something into that.
You know, I'm actually more interested in the ISM manufacturing data that comes out at 10 a.m., an hour before Fed Chair Jay Powell, because ultimately it's going to be about the data and the trajectory and sort of some of the benchmarks that people have. What do you make of the fact that manufacturing continues to be in recession, has been in recession for a full year or so, and that people are viewing that as an isolated sector that continues to be in a world of hurt, even as services continues to chug along?
Well, that is sort of the dichotomy of the economy at this point. People are buying services, they're not buying goods, so we have seen a decline in manufacturing. However, this could be an interesting ISM. We'll have to see how the numbers come out, particularly for orders and production, because remember we had the UAW strike, and that didn't get settled until October. So this November number for ISM is probably going to show a rebound from just the workers going back to work on the assembly line starting up again. So we'll have to shade that a little bit off. And it's going to be the same a week from today when we do the jobs report, because we'll have all those auto workers back on the payrolls.
Is data weakening? Do we see economic data weakening, or are we seeing ongoing strength with the fastest pace of GDP growth in quite a while in the third quarter, along with disinflation that people are just saying is enough weakness to sort of create nirvana?
Well, that depends on how you define weakness, I guess. Yes, the data show that things are weakening in the economy. Consumer spending is a little bit slower than it has been, and we're seeing hiring slow down. We've seen jobless benefits rise a little bit, but this is all a little bit. It's on the margins. The problem is you don't know if that leads to recession, and Bloomberg Economics still hanging under their recession call, based on the fact that all of a sudden you get a nonlinear drop in confidence, and then everybody stops spending. What would cause that? I don't know. But it is a possibility. So we're seeing rates, the forecast for rates cuts in 2024 really pick up steam in recent days. There's two camps, the people who think that we're going to have this nirvana thing, inflation's going to come way down, and that'll bring real rates up. And then there are those who still think that there's a possibility of a recession because the economy is slowing. And historically, when it has done that, it hasn't stopped. It keeps going.
Michael McKee, stay close, please, as we parse through what we can expect heading into the weekend and into next week. I got this message from Drew Mattis over at MetLife, basically saying, we have not had a normal recession in more than 20 years. Most traders have never seen one. Maybe this is why people don't know what to make of the seemingly disinflationary nirvana, as some people are calling it. Lauren Goodwin joining us now, economist, director of portfolio strategy at New York Life Investments, director of disinflationary nirvana narratives. Do you buy it?
I don't buy it. I think we're sitting there right now, but that it's a stop on the train towards recession. And the reason for that, twofold, really. One is the long and variable lags of monetary policy. We're sort of right on time for an average recession timeline from the first Fed rate hike. But the other is that if we did get a cut in March or May, and inflation wasn't falling precipitously, we weren't heading towards recession, then I think we'd see financial market conditions ease pretty significantly. And Chair Powell and other Fed members have been very insistent that they don't want to see that. That's a recipe for likely a reacceleration of activity and makes the inflationary environment more sticky.
So when we take a look at where you want to play the best returns for 60-40, going back to 1991, do you lean in or do you lean against it and say someone's got to be wrong here? Whoever it is, I'm going to move against.
Well, as much as ink that we've spilt. I'm a part of it. As much words we've put out there about the soft versus hard landing debate, neither side has been the winner for investors all year, and I expect that to be the case for the first part of 2024 as well. What I mean by that is the only thing we're really certain about is that the market is facing uncertainty. And so landing strongly in one camp or the other isn't likely to be the answer. It's quality. And I think we're seeing that over the course of this year, investors leaning into profitability, to dividend yields, and to areas of the market where investors expect that no matter what happens in the first half of next year, they can build some resilience.
So when in doubt, buy Microsoft. Is that basically what you're saying? I mean, essentially, that's basically been the market narrative so far. Or they're not the market narrative. This is what people are saying. We don't know what's going to happen. We'll just buy big tech and sit and wait.
It's a part of the story. One of the things I think will shift over the course of 2024 specific to the tech narrative is that the excitement around productivity and the new technological developments we're getting from the artificial intelligence trend have been centered in the foundational layer of tech, not least because that's also where consumers spend money. As the consumer experiences the sort of dissonance of high price levels that you've covered so well, I expect that more of the story around tech will actually expand into the digital infrastructure and the application layer that get built on top of the foundational layer of tech.
Which really is sort of part of the difficulty understanding what's going on, because there are these sort of secular overlays like artificial intelligence, like weight loss drugs that are put over a lot of uncertainty and frankly a lot of underperformance of other rank and file companies. We saw, for example, over the past week, pretty big inflows into large cap U.S. stocks. We saw outflows yet again from the Russell 2000. What do you make of that? That basically small caps are going to be left for dead in a sense and continue to underperform dramatically, even with some sort of settling out in this narrative.
Small caps, as the economy slows, tend to underperform because they don't have the overhead, the administrative overhead that helps them to digest higher rates, higher costs, the way that large caps do. So it's not necessarily a matter of sector, but one of business model, one of truly size. I think there are a couple of exceptions. The tech sector is one of them, where profitability can exist in mid and small caps as well. But as we move through into Q1, I expect that the preference for, frankly, defensive allocation plays, large caps is one of them, defensive sectors, I really like infrastructure equity there. I think they're going to continue to gain ground because we're going to see more evidence that the data is slowing.
Isn't the best defense just cash?
There are benefits to cash when you're expecting a major fallout in the market, but one of the things that I think is so challenging about cash right now is that we see such strong opportunity to harvest yield in sectors of the economy that even if we see recession, which I expect, and even as spreads widen, you can still gain meaningful yield uptick in, for example, the high yield bond market.
Funny that you say that. High yield bonds had the biggest 4-week inflow going back to June 2020. This according to Bank of America, Michael's Hartnett. This to me highlights exactly what you're talking about. A lot of people are saying we don't have certainty about where things are going. We're going to pile into cash, $75 billion going in there in the past week. But we're also going to pile into income, because we know we're going to get something. Are you seeing sort of the reversal of the bond stock dynamic over the past 2 decades, where really bonds are your equity drivers in some ways, your income plays, and then you can sort of shoot for the moon on the peripheries with some equities?
Yes, that is what we're seeing. But I think what's specifically interesting about high yield is that we see investors, and we're doing the same, taking equity-like risk in high yield because you can harvest a meaningful coupon on these bonds while acknowledging that Fed programs early in the pandemic made the credit quality of this sector much more interesting relative to past economic cycles. So even if you expect spreads to widen, prices to fall as the economy stumbles, you can still make up for it with the income that you're able to capture from that sector.
So is that your highest conviction heading into next year? Can you give us a sense of kind of how you're framing at a time where there isn't a lot of conviction?
Yeah, so I want to be clear that even though we have a recessionary call in the first half of the year, I don't think that's particularly pessimistic. I think that's an optimistic scenario for the economy. It allows a reset. I also think that we're going to see risk assets continue to do well for the next couple of months. So what we're doing is taking advantage of this sugar rush while we have it to rebalance into themes that we think will work particularly well. We've talked about a few of them. Defensive sectors. I really like infrastructure equity. We like high yield. And I do think that there's room to run in duration as well.
Do you think that the Cybertruck is attractive?
I will admit that I just saw it for the first time after hearing John say this morning it looks like a kindergartner drew it. Okay. And I could not disagree.
Okay, well, where have you been? Hiding under a rock? This thing has been out there. Lauren Goodwin, thank you so much for being with us. Wonderful to see you. Lauren Goodwin of New York Life Investments, thank you. And she, of course, will say, no, Lisa, you've been hiding under a rock because I haven't seen, what movie haven't I seen?
Die Hard.
Die Hard, which I guess is a bad thing. And that
it's a Christmas movie. I said it.
It's a Christmas
Why
movie.
is this a debate?
Everybody agrees it's a Christmas movie.
Okay, so I'll watch it for Christmas.
Look on social media and just put in Die Hard and you'll see this enormous debate goes on every year.
It's real. It's a real debate because check out social media. I will check out social media and I will watch the movie. Thank you for being with us, Lauren. If you are just joining the program, we do see a bit of a pause after a massive week, a massive year of gains, a massive month of gains. Year, month, it feels like the same thing. We've seen a gain of almost 11% for the NASDAQ going back to early last year, the biggest gain. We can see the S&P futures just off a touch now, down 0.2%, 45.68. Coming up, we're going to discuss another key aspect of technological advancement, which is weight loss drugs. We are going to be speaking with Madison Muller and Sam Fazeli on the latest issues in the weight loss industry. We were speaking about Pfizer and how the shares are lower there by 4.7% after they withdrew an early stage trial for a 2-day pill, twice-a-day pill that could potentially compete with some of the other weight loss drugs. I just wonder, Michael McKee, still with us here. I'm curious whether Fed officials are looking at some of these trends. I know that they're looking at AI. Do they look at the weight loss drugs and say, how is this going to transform productivity? How is this going to transform where people put their money?
Well, remarkably, all the Fed officials I know are in pretty good shape, so I don't think they're going to be buying it themselves.
They are, right? They all go hiking and things?
They all go hiking. But in an abstract sense, you wonder about what the long-term issues might be until insurance companies pay for it. It's not going to be a big deal. But yeah, there could be some things down the road. I don't know how much it adds to productivity, but it might change some consumer spending patterns at some point.
I just wonder how they kind of discuss these things, because it is something that at least the market is treating as a potential game changer. And it would potentially change economies. I don't know. I mean, health insurance, think about how big of a proportion of inflation health insurance is. What if that comes in? Is that disinflationary or deflationary? I mean, these are some of the things that they've got to think about.
Well, health insurance has been inflationary, and it'll be interesting. We're coming up on the renewal periods, so we'll see how much premiums go up in the next year and whether that adds to inflation. Usually does in the month of January. But I don't think we have to worry about the weight loss drugs yet, because it's really hard to get insurance for those.
Well, we shall see whether that changes, because I know that's a big debate and there's some bipartisan support on that. Michael McKee, thank you so much for being with us. Coming up, we will delve into that conversation. Right now, we can see a bit of a pause. Yields, massive, massive month. We can see now 4.33% rounded up.
We are waiting to see the results. It's all about data. Data will speak. If the data are good, we are going to move into phase 3. We thought that the market would be 90 billion altogether, of which 1/3, 30, will be the orals. Right now, the market looks like it will be even bigger. So, yes, it is a sizable opportunity if you have an oral anti-obesity drug.
That was Peter Bourla, Pfizer CEO, speaking to Bloomberg back in October on their weight loss drug, talking about the oral application rather than the injectable. The data has spoken, and Pfizer falling this morning after stopping development of its experimental weight loss pill after side effects forced more than half the patients taking part in a study to stop taking the drug. Pfizer has fallen significantly this year as the pandemic fades, even as you see the others, the competitors, competitor drug companies, weight loss drugs made by Eli Lilly and Novo Nordisk, spurring massive gains. Joining me now, I'm so pleased to say, Sam Fazeli, senior pharmaceutical analyst at Bloomberg Intelligence, as well as Madison Muller of Bloomberg News. Madison, I want to start with you. There's a real question here about how significant of a setback this really has been for Pfizer.
Yeah, well, Pfizer has really been pinning its hopes on this weight loss pill. Other drug makers are clearly trying to get in on this market. It's become so big. It's the hottest thing in pharma, as we keep seeing. And one of the ways that Pfizer and AstraZeneca see an inroad into this market is with weight loss pills. They're sort of banking on the fact that people will prefer pills over injectables. And Pfizer's really struggled this year as the pandemic fades. And so a lot of its hopes were being sort of pinned on these weight loss pills. And this is definitely a setback for them right now.
Sam, I have to say, when I heard about the side effects, it sounds similar, but maybe more extreme than some of the side effects for the injectables. How closely are these things being examined, not only for the short-term side effects, but the longer-term side effects?
Yeah, the longer-term side effects will, by definition, take time to come through, although these drugs or these mechanisms of action have actually been used in diabetes patients for over a decade now, starting in around the early 2010s. The shorter-term side effects, which is mostly gastrointestinal, nausea, vomiting in some people, discomfort, those are common across the drugs. In the case of Pfizer, this data suggests that it seems to be a lot higher than we would have that we saw with the current drugs, Wegovy and Zepbound, which is just recently launched. The issue I think here is that first it's an oral drug, so you're delivering it to the gastrointestinal tract, and secondly, because it's twice a day, it's possible that you're getting peaks of drug release that are causing that. So maybe their once a day drug will deal with this problem.
How much daylight, Sam, is there between the different drugs that generally target the same thing?
Yeah, based on the data that we have today, Eli Lilly's Zepbound, it seems to be the most effective drug. Now, none of these have really been compared head-to-head. So you really need to go into a randomized head-to-head comparison, and the companies are doing that. So they're confident of the profile of the drug, and they're doing that comparison. It does look like Eli Lilly's drug is the more effective one, that's Zepbound, followed by Wegovy, and pretty much everybody else comes up with about the same sort of weight loss that you see with Wegovy at the best, and then potentially a bit lower.
Madison, how much is Pfizer kind of late to the game, in part because they were distracted by the pandemic and they were so focused on really developing the vaccine, rolling it out, and being in the spotlight for that?
Yeah, I mean, they are a little bit late. Novo Nordisk and Eli Lilly clearly have the lead in this market. They also have the lead in developing pills. Novo Nordisk already has a pill version of Ozempic. It's called Rybelsus. They're developing a higher dose version of that. That's going to be essentially a pill version of Wegovy, their weight loss drug. Could be available as soon as next year. Lilly's weight loss pill, or Orforglipron, looks really good. It's advancing ahead, and so this data and the fact that Pfizer is discontinuing this trial sort of puts them back even further. But it's important for other drug makers to enter this space because eventually it will hopefully help bring down costs and everything in the market.
The other thing that would bring down costs is if insurance has to pay, and there is some sort of collective negotiating from that front. How much is that in the discussion, especially with some of the benefits that are associated with losing weight in certain patients?
Yeah, so I mean, that's why these drug makers are doing a lot of studies right now looking at other indications. So we've seen this with heart disease. They're studying knee osteoarthritis, sleep apnea, all of these other indications, because we know that cardiometabolic conditions are very interrelated, and they have, obesity is linked to like 200 other conditions. And so these studies are a really important piece of that in convincing insurers that these drugs are worth covering. But so far, the landscape is still pretty spotty there.
Sam, I'm curious your perspective, because you've been covering in the pharmaceutical industry for a very long time. Do you think that is a big part of the game plan? That yes, that these drugs have to be taken long term in order to remain effective, and that ultimately insurance companies will be prompted to pay for them?
Yeah, I mean, the problem is often solved in the single-payer markets, because the same people who pay for the drugs are the same people who pay for your hospitalization costs, etc. So that's the critical element here, in that what the US system needs to do is to look at the longer term benefit of these drugs. The cardiovascular benefits that you were just talking about, the potential effect on blood pressure and even Alzheimer's. I mean, time will tell. They're being tested in Alzheimer's. It is possible, as Madison said, that these drugs are, that obesity is related to 200 other diseases. If you manage that, you overall reduce the burden on the healthcare system. So I think insurance companies will eventually have to pay for it, but they're going to try and get these prices down as much as possible. And frankly, we have to say that we think that the rebates on the list prices that you see for these drugs is already at around the 50% mark. So, and that's just going to get deeper as we go forward.
Is it true, Sam, that you have to keep taking it or else all the weight and then some will come back?
I mean, let me put it this way. Just take it the other way. If you diet, which also is basically the same idea of eating less, which is what Wegovy does to you, reduces your appetite. If you diet, you lose weight. If you stop dieting, your weight goes back up again. So it's the same principle. You're not resetting, unfortunately, the underlying, whatever the reason is, driver of your increased appetite in obesity. Now, maybe over the long term, if you use these drugs for a year, 2, 3 years, you might be resetting that desire level. I don't know how the biology of that would be, but that would have to be shown.
Madison, how much are people using this for medical reasons and how much for cosmetics?
That is something that still sort of remains to be seen. I mean, there is a ton of off-label usage happening, and that's being driven by, hype in Hollywood and social media. And we know that people are, who might not necessarily have diabetes or obesity are taking these drugs, are seeking out even knockoff versions that are not approved by regulators in the US and outside of the US because the demand is so high. But these drugs are really, really life-changing for people with diabetes and obesity who need them. And it's important that those people have access to the drugs. And, that's something that's still sort of a challenge.
How much of the pharmaceutical money is sort of shifted toward weight loss?
That is where it's going. I mean, that's the market that is expected to grow to be, potentially $100 billion by 2030 is that obesity market, just that. And so that is really what the drug makers are looking at. And some of the drug makers that are still looking at getting into this market are targeting the weight loss side of it.
Sam, from a scientific standpoint, I'm curious what your biggest concern is, because some people would say it sounds too good to be true. It's something that people have always been looking for, is a pill or something, rather than go to the gym, that makes them shed all the weight. What is your concern longer term about some of these pharmaceuticals?
I mean, as I said, the Novo Nordisk and Eli Lilly have been using these drugs, these mechanisms, for treatment of diabetes for several years and over a decade now with regards to Novo Nordisk. So we know, at least at certain doses, in the diabetic population, what their risk profile is like. And nothing has really come out of the blue to surprise anybody. Maybe over the long term, when hundreds of millions of people use this, which would be a phenomenal boom for the pharma sector, some very low levels of side effects come out. At the end of the day, you are introducing a therapeutic, a drug into the system. Just doing weight loss by using diet and exercise, that obviously is the ideal way. But we clearly see that that's not sufficient. So I'm not really worried about side effects, given what we already know. You never know what's going to happen. With the one drug I do worry about a little bit is the high dose that Wegovy uses, which is Novo Nordisk's. And that's higher, that's been used on average in diabetics. But as time passes, and that also shows no major safety concerns, I don't lose sleep over it.
Bloomberg Sam Fazeli, Madison Muller, both of you, thank you so much on an issue that we will be talking more about inevitably over the weeks, months, and years to come. Right now, in markets, basically going nowhere after nearly 11% gain on the NASDAQ, more than 9% gain on the S&P. Coming up on Bloomberg Wall Street Week tonight at 6 p.m., Catherine Keating of BNY Mellon Wealth Management, former U.S. Treasury Secretary Larry Summers, and Jean-Yves Fillon of BNP Paribas. This is Bloomberg.